Welcome to the March UCLA Anderson Forecast conference, where we're going to do our economic rollout. And this conference is joint with the EASTON Center for Technology Management here at UCLA Anderson. And our theme today, something that we're going to dig into, do a deep dive into, is technology and healthcare. And as you're going to see in some of the numbers, healthcare is one of the fastest growing sectors in terms of employment, but it is also a sector that is in flux. There are many, many changes going on in the way in which business is done in healthcare, and this is a sector in transformation. And so what we want to do is take some time, talk about that, think about where it might be going, and the questions, the obstacles and challenges that lie ahead for the healthcare sector. And so our program today, we're going to start off with the forecast, so US and California. We are missing one of our forecast team, Professor Ed Leamer. Ed, as many of you know, has been at UCLA for many, many years, was a former director of the forecast, and he has a really interesting presentation. But he was in Florida last week, and apparently the pandemic's not entirely over with. So he's still in Florida, unfortunately. He's feeling better, he's getting better quickly, but we did have the opportunity to record his remarks. So we're going to do that, and then we're going to turn to Leo Feller right here. Leo joined the forecast a few years ago, received his PhD at Brown University, and came to us from Cornerstone. And then I will follow that with the California forecast. We'll have time for Q&A. We'll take a break, and we'll do our deep dive into healthcare. And the one thing that I forgot to do, for those of you who don't know me, is introduce myself. I'm Jerry Nicholsberg. I'm the faculty director of the UCLA Anderson Forecast and teach here in the MBA program. I've been the director of the forecast since 2017, and I'm going to be the MC for today. So let's, before we get started, we're a public university, as you all know. We could not do our research or put on these programs without the generous support of our sponsors. And so I want to thank them. And first, special thanks to Richard Ziman and Steve Gordon for establishing the Ziman Center Real Estate Economist, who should be joining us, joint Ziman and Forecast, in around July. And so look for some really interesting research on real estate in California, on housing policy and the like. So many, many thanks to them. And to Edison International in Southern California Edison, who through their generosity have provided funds for the Forecast Fellows program. This is a program where we mentor some really bright undergraduate students from underserved communities from California State University, Dominguez Hills, in research and in pathways to graduate study. So many thanks to Edison International and Southern California Edison. And our sponsors for today, principal sponsors RSM, platinum sponsors, the law firm of Allen Matkins, California Bank and Trust, Cathay Bank, Clark Construction, Leap Development, and University Credit Union. At the gold level, Avenue Insights and Analytics, California Steel Industries, Venture Forward by GoDaddy, Hub International, Pacific Western Bank, Robert Half, and United Airlines. And at the silver level, we have Bank of California, Scott Work North America, US Bank Private Wealth Management, Union Bank, the Private Bank, Valley Bank, and at the bronze level, HDR and Marsh McClellan Agency. At the Bruin level, Gerber Kawasaki Wealth and Investment Management, Keenan and Associates, Navitas Health Solutions, and our academic sponsor, UCLA Extension. So before we turn to Ed, what is on everyone's mind is Silicon Valley Bank and what's happening there. And there are a lot of pundits who are telling you what's happening and what that means. But we have an outstanding faculty here in finance who do research in this area. And so I started asking them, what does your research tell us about what's happening? And I want to give you a quote from Professor Barney Hartman Glazier, which sort of summarizes what is going on here. He says, it's still early. So that's important. We have one data point. It's still early, but the FDIC using the systemic expedition to cover uninsured deposits for Signature and SVB is certainly big news. I don't think we can know yet what the eventual fallout will be, and then follows with, let's hope it's limited. And to put that in context, the question that our finance faculty has raised is this long-term capital? Big non-bank financial institution that failed in 1998. It was bailed out, considered too big to fail, so very similar to today. And the economy kept chugging along all the way to 2001, till we got the 2001 recession. Or is this Bear Stearns Lehman? And the answer is, we don't know. And a lot of that depends on what the Federal Reserve does. So what that tells us is there's more uncertainty. And so we have to watch closely as we look at the way economic events unfold to see kind of what trajectory. And you're going to see today that we're looking at a couple of possible trajectories. And so with that, let me turn to Ed. Ed, welcome, however, virtually. And can we start the video?
Okay, it's great for me to be here today. I'm actually in Florida, spending a week with my brother and coming back to Los Angeles on the day that you're having this event. And
that's
I'm
what
a
he
big
thought.
believer in questions and answers, that education is conversation. And I would be happy if you wanted to ask me questions, but I won't be there in person. But if you sent me queries after this event, I'd be happy to respond to it. I learned from your questions, so go ahead and do that. The questions I'm going to answer today are the following three. What's a recession? And you're thinking it's 2 negative quarters of GDP growth. I don't think so. I'll explain why in a minute. What are some precursors of recessions? The one that's talked about most frequently in the newspapers, and most economists think of it as the best indicator, is the slope of the yield curve. The yield curve measuring, and depending on how you define it, measuring the difference between the 10-year yield and the 3-month yield or the 2-year yield. It's the inverted yield curve with the short-term interest rates higher than the long-term interest rates that are pretty good precursor, pretty good predictor of recessions. And then the third thing is, what about the forecast? So that's saying, what are the precursors saying through 2022 Q4? So if we look at the whole year of 2022, we want to know, is there evidence that the data that we already have about 2022, does that look like the precursors? If it's so, then we've got a recession in the works, a recession in the works soon. So to get this started, this is a picture of the unemployment rate. And the horizontal axis goes from 1948 to 2023. The vertical axis goes from 0 up to 16. So 16 is by far the highest unemployment rate you really ever see, but it was close to that. It was 15, and that COVID-19 month, immediately after COVID-19, it was a real outlier, a really strange thing. But here's a task which I want you to carry out for me. Help me out doing this. You can see this looks like a bunch of mountains, a mountain range. And what I would like you to do in your mind's eye is to color the slopes in the facing the westerly direction, that is to say your left, color them in yellow. So look at this picture and imagine that those slopes are all colored yellow. Can you see that? I think you can. It looks like this. But those yellow that are painted weren't painted by you. They were painted by the National Bureau of Economic Research, who defined those as recessions. So recession is a period of sharply elevated unemployment rate. And that leads to, I think, the best best description, theoretical description of a recession. It's a period of sustained unwanted idleness. idleness of labor is what you see in front of you, but there's other forms of capital idleness, which is low rates of capacity utilization in manufacturing, apartment buildings, and office buildings that are not fully used. That's the unutilized resources, unutilized productive resources. Something's wrong with the economy that leaves those things unutilized. So then if you look at that little line, that takes us from an unemployment rate, which is today's number, about 3.5%, to the time when it was similar to that, way back in 1969, I guess. But in getting your eye to do that, I'd like you to look at this image and tell me whether we have right now an exceptionally low unemployment rate. Should we be celebrating that low unemployment rate as not a precursor to recession, or is the opposite conclusion implied by? So take a look at this picture and answer my question. I wish I could see you raising your arms in order to answer the question. But I think what you're doing is you're looking to see what's the unemployment rate like immediately before these yellow bars. And the answer is it's low. The unemployment rate is high in the beginning of the expansion, and it's always low at the end. So the low unemployment rate is an alarm that a recession is coming. It's not a statement that we don't have a recession soon. So now I'm going to carry out an image that does exactly what you did in your head, but it's going to be a picture of what you did. And what we see at the horizontal axis here is that 3 years before recessions. The first year is at the right, the second year before recessions in the middle, and the third is at the left. 12, 8, and 4 refer to the number of quarters. We're going to work with quarterly data. And what we're going to make is an image of the unemployment rate in the years before recessions, in the 3 years before a recession. So this is a data set that ends in 1957 Q3. That's the last quarter at the right. The next quarter, 1957 Q4, is a recession. So you can see unemployment is slowly declining. There's not a big increase in the recession immediately before the recession. This is 1969 Q4. So what we're going to do is what you did visually. We're going to take all of these episodes, all these expansions, and map them into this picture so we compare one with the other in terms of the way unemployment is behaving. That was 1973, 1980, 1990, 2001, 2007, and doesn't look very dramatic in terms of changes. It does go down some. As you can see, it goes up a little bit. That's the means. The dots represent the means. And then into this picture, I'm putting the most recent data, which is the 4 quarters of 2022. That's the triangles. You got that? Get rid of them and put them back in. So what we're trying to do statistically is take the most recent data, which is what we see here, and place it in among the historical data in a way that it's closest to what the historical data look like. And my algorithm places it right there. I don't know where you would do it. I think it's kind of hard to place the unemployment rate. We're going to see that indeed that's the case in a couple minutes. But that's the algorithm that we're going to use. We're going to put all these images, all the recession, pre-recession years in the same image, and then try to place the 2022 data in the midst of that historical data. So as a way to feeding in here, this is the same image from 4 to 8 to 12 quarters. This is the mean and standard deviation of residential investment contribution to GDP growth. And GDP growth is typically on the order of 3. And over here on the left, you can see that the average is around 1 and exceptional is about 1.5. So those are big numbers. That's where residential investment was making a significant contribution to GDP growth. But over on the right, closer to the recession, it dips down dramatically. So it looks as though a fall in the residential investment would be a valid precursor of an oncoming recession. And to talk a little bit about this statistically, that's the one standard deviation error band at quarter number 11. And if you take that data and move it over to the right, it's above, completely above the error band that applies in quarter one. Well, that's saying that if you were trying to distinguish quarter one from quarter four statistically, it'd be pretty easy to tell where that data came from. It wouldn't be a hard problem, but it is a little technical. So now I'm going to do a little bit of more technical material. And this is an image that shows you how I'm going to take a mean and standard deviation from two of these quarters, and I'm assuming that they're normally distributed. We want to ask whether you can confidently distinguish between the first quarter and, say, the 10th quarter. So let's assume that the one quarter is normal 0, 1. That's the blue shape. And the other one, the orange, is normal 1/2 and standard deviation 0.4. And you can see that when the orange is above the blue, then the data are favoring the orange. When the blue is above the orange, the opposite is the case. So up at the top, I have identified the interval over which the orange exceeds the blue. That would be your decision-making opinion. You would, if it was in this interval, then you would go with the orange. And that happens with probability 88%. So a very high probability of getting that right. And then the opposite would be, suppose that you get an extreme observation. And if in the extreme one, the probability of getting that right is 0.48 plus 0.11, about 59%. So if you didn't know which distribution you were drawing from, and you had a 50-50 chance, then the probability you were going to get this right is a simple average of those two numbers, simple average of 0.88 and 0.59. I don't know if you get that, but I wish we had time to talk about it, so maybe it would become more clear. But what that does, that supports the following.
Okay, so we decided not to re-record this with more time, but I get to stream Professor Lemur in the metaverse here and just give the additional explanation. So, you know, what he was showing you, you remember that graph prior to the one with the distributions. You have a band that's up here and a band that's down there. And then we get today's data and we say, well, is it really close to this? If it is, that was that orange one where you have a lot of confidence that it's in the 10 quarters before. Is it really close to this low one? Well, then you have a lot of confidence that's also that orange. But what if the data comes in the middle? So it's between those two. So where do you put it? And he's using those probabilities to say, here's where we put it between the 10 and the recession next quarter, right? So that would be the blue where it's kind of really diffuse and you sort of don't know. And the algorithm that Ed has developed, statistical algorithm, moves that around till it finds the best fit. How close is it to the lower one or the upper one, and puts it there. And hopefully that made it a little more clear, but let's go back to Ed.
Image. So here we have residential contribution to GDP growth. On the left, you had the mean and standard deviation. That's what we displayed in the earlier graph. And it's quarter 1 to 12 on the vertical and quarter 1 to 12 on the horizontal. So let's look down the diagonal. Those numbers, that's the lowest number. This is the probability of distinguishing two quarters, one from another. If you look up at the upper left, you see a 0.51 in the distinguishing 11 and 12. Well, 50% is the worst. You can just flip a coin. So 11 and 12 are so close together, there's hardly any information that would allow you to distinguish the two. And these diagonal elements that I've identified here, that's true all along. So not surprisingly, it's have a hard time distinguishing adjacent quarters. But if you wanted to find the best distinction, there's a 92% chance that you would distinguish quarter 1 from quarter 10. That's exactly the image that we were looking at before. I mean, we looked to see that Q1 and Q10 were very different. And this says indeed that's the case. And there's a 92% chance if you saw an observation, you were trying to decide whether it came from Q1 or Q10, the answer, your accuracy would be 92%. And then, whoops, previous, I'm going to go back there. And you can see these dark numbers in the lower left. Those are all large. Those are distinguishing the 4 quarters before recessions with the 4 quarters in the year immediately before recessions with the 4 quarters in the third year before recessions. You got that? So there's a pretty high probability of making that distinction correct. That's why the residential investment looks like a pretty good indicator of when a recession is going to come. So I want to alert you to one of the other variables that I'm going to use is the yield curve, the slope of the yield curve. And I'm going to use the difference between a 10-year and a 3-month rate. That's a typical slope, a couple hundred basis points maybe. And more recently, it's been an inverted yield curve with a downward slope. So when I say the slope of the yield curve, you understand what I'm talking about is 10-year yield minus the 3-month yield. And then use those calculations based on those bivariate comparisons and ask which of these variables, 18 variables, can reliably distinguish the first year from the third year before recessions. And what we have are 15 components, contributions of GDP of 15 different components of GDP. For example, residential investment was the one we were talking about before. The next one here is consumer durable goods. And then I've added also the slope of the yield curve, the interest rate spread at the top of this slide, and the unemployment rate and the oil price, which are way down at the bottom. So the unemployment rate is not a reliable indicator of an oncoming recession. But at the top, the 3 most reliable variables are the interest rate spread, the residential investment, and consumer durables. So we're going to focus on those 3. Here's the image of the interest rate spread. If you look at focus on the left side, don't look at the right side yet. The left side shows you that the average interest rate spread is definitely falling going into the last year of recession, but it spikes up a little bit in the quarter before the recession actually occurs. So at that point, the Fed is saying, oh my God, we made a mistake. Let's not have such high interest rates. And then that is what I would say ideally or algorithmically placed most recent data. And the most recent data has a problem, which is the first 2 quarters of those triangles are high, very, very steep yield curves, almost 2 percentage points, 200 basis points. And the last 2 are much smaller. And the last one is actually negative. So the problem is, how are we going to place those 4 data inside this image when there's nothing like it? So the algorithm does the best it can and puts that in, puts the last observation at recession at quarter 5, 6 before the expansion. You got me? So over here on the right, that represents the probabilities that my algorithm creates for placement. And it says there's a 72% chance that that placement that you see them on the left is the best available among all the others. That's if you use all 4 of those observations. That's 4 quarters during 2022. But if you restrict yourself to 1 or 2, you get rid of those steep ones, those earlier ones, and then you get a smaller increase, but an increase that is higher toward the end of within the first year of recession rather than in the second year. So I think that what the Fed does next is going to change that 4-year. The first year is not going to be as high, and the second year is not going to be high, and we might get a total revision of this image that I've just given you because of the unusual character of the recession, of the interest rate spread that is illustrated here. Here's residential investment, which we looked at before, and that little line shows you the last 4 quarters. You can see the housing is really troubled in the year before recession, and that is our most recent data, about as troubled as it could be. The contribution to GDP growth is like almost 1.5% in that one quarter. And the next quarter, more than -1. So those are really big numbers and unusual lagged, extreme observations in this data set. And then if you look over to the right, the probabilistic placement doesn't depend on whether you use 1, 2, 3, or 4. They all, 1, 2, or 4, the placement is about the same for all 4 in terms of higher probabilities near the end and a peak of maybe 33% in the first quarter before recession and 33% in the next quarter before recession. So residential investment is definitely ringing out an alarm. There's no question about that. So this is consumer durables, and if you look over at the left, consumer durables, even the means are wild up and down. And if there's any evidence, if it's extreme right, it's where the means go negative. So it looks like if you get a couple negatives, that's a symptom of the last 2 months of recession. And that's exactly what we've had. The diamonds represent the last 4 quarters. I said months before, but I meant quarters. The last 4 quarters of the data set, which are the 2022 data, and the last 2 quarters were negative. And consumer durables says, well, that's a 30% chance of a recession, meaning that a 30% chance that we're in a recession right now. That this quarter, that says that the image you see is saying at the quarter after that last one on the right, which is the quarter after the last diamond. The last diamond is 2022 Q4, and the next quarter after that is 2023 Q1. So that's what we're really doing, is talking about a prediction that's a 30% chance that we're in a recession right now. So we're going to have to somehow put these things together. I put them all in one chart here. So this is residential investment heavily favors. This is the 4 based on 4 quarters here. Residential investment wants to have 6 quarters, and I'm sorry, previous, and these other 2, the interest rate spread and consumer durables, don't have that kind of sharp preference or anything earlier. They want to have the year before. They want to make the conclusion that we're in a year before recession, but not 2 years before recession. You mix these all together econometrically, and that interest rate spread dominates. So you can't get away from the fact that the interest rate spread is having a big impact on the decision. But even with it in there, there's a 55% that will be in a recession, or that the recession will start not in 2022, but not in 2023, but in 2024. But again, I said, I worry that these conclusions are going to be much influenced by the Fed's behavior that's going to occur soon enough. So thanks for listening. Take a breath and send me an email with your questions. I'd be happy to respond.
Okay, thank you, Ed. That was heroic. Doing that recording while you were feeling poorly, just illustrative of how dedicated Professor Lemur is. But what he showed us was 2 possibilities, which led us to do 2 scenarios. And so let's turn to Leo. Leo, what are these 2 scenarios, and what do we glean from the data?
All right, well, thanks very much for joining us. So the big question that's on people's minds is, are we going into a recession or are we not going to have a recession? So let's start off by reading, this is just last week. It's amazing how time flies. What Fed Chair Jay Powell was talking about during his congressional report. He said, in light of cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee slowed the pace of interest rate increases over its past 2 meetings, right? Basically, it's saying, look, it takes a while for higher interest rates to have an effect, and let's see what's going to happen, so let's slow down a little bit. It only took a few days more for us to start seeing some of the effects of those higher interest rates. Then he says, we will continue to make our decisions meeting by meeting, taking into account the totality of incoming data and their implications for the outlook for economic activity and inflation. So then the next part is basically saying, all right, we're going to be data dependent. Depending on how the data is coming in, we are going to decide what to do next. Well, we've gotten some data that has come in since he made this speech. First, we had Silicon Valley Bank. We're seeing much greater risk in the banking sector. And then also we got inflation yesterday and advanced retail sales today. The inflation data yesterday is moving in the right direction, but not fast enough, right? So inflation is staying higher for longer. It's proving to be sticky. And problematically, the component of inflation that the Fed tends to focus on, which is core, right? So excluding food and energy prices, that actually ticked up a little bit in February, right? So problematic for the Fed because inflation is still running pretty hot, but now it also has to deal with this problem of financial instability. And so what is it going to do next? We're presenting 2 scenarios. One scenario is that the Fed is going to keep increasing interest rates. And that scenario basically says, look, all this financial instability, this is a blip, right? If you ask financial markets what they're thinking, they're all over the place, right? There was no financial crisis happening as of this time last week. Then on Friday, everyone thought there was going to be a financial crisis. And then, on Sunday, the financial crisis was averted. Then on Monday, the financial crisis was back on. Then yesterday, it was averted. And then today, it's back on, right? And so if you're actually looking at the data coming in real time, right, that's going to be a really messy way to make any kind of decisions because the data really is all over the place and market sentiment is all over the place. So let's assume a scenario where, the financial concerns settle down a bit. We don't have more massive bank failures. We don't think there's massive instability in the financial system. In that scenario, the Fed continues to increase interest rates, right? Perhaps it takes a pause at its interest rate meeting next week, but it keeps increasing interest rates thereafter to combat the inflation concern. That's the recession scenario. The no recession scenario basically has the Fed pause and say, okay, wait, there's too much instability, there's too many concerns. Let's stop and wait for a lot more data to come in so that we can have more certainty about what's going to come next. I'll talk about the implications of these 2 scenarios on economic growth, on unemployment, on housing starts, autos, inflation. There are a few constants across both of these scenarios. One is higher defense spending. So no matter what, we've modeled in both scenarios that the federal government is going to be spending more on defense, right? Ukraine, Russia, potential concerns about China, that's still there regardless of the economic scenarios. The other constant is infrastructure spending, right? The government has already passed infrastructure spending bills that suggest we're going to have higher infrastructure spending in these next few years. And then we have not modeled a government shutdown. I can't imagine a situation where on top of all the current concerns and instability we have, we also throw in a concern about the government defaulting on its debt, but you never know. We just haven't modeled that so far. All right, so what do these 2 scenarios suggest for when a recession might come and how deep it might be? The red line is the recession scenario. The green line is the no recession scenario. This quarter, we're actually still pretty strong. We had 3% growth in retail sales in January. Right now in February, the data that came out today was a little bit of a contraction in retail sales, but still from a very high level, right? So consumers are still going out and spending. That's powering this 2.3% growth that we're expecting this quarter. The question then becomes, do consumers really start pulling back, right? Do they get concerned about banking situations, about a potential recession? Do banks try to shore up their balance sheets and stop lending? That might lead us down into this path of a recession. The no recession scenario, the economy slows down. We get to the peak of the slowdown, right? That would be the 0.4% growth that you have at the end of 2023. Then the economy picks back up and we grow at our normal 2.2% rate. In the recession scenario, because we have this big decline, we have a stronger bounce back and we grow a little bit faster in the outer years of our forecast scenario. Putting this on a year-over-year basis, what's the difference between the no recession and the recession scenario? Well, by Q1 2024, the economy is 1.5% smaller, right? So the economy contracts, whereas it would have grown more slowly in the no recession scenario, and we have a slightly smaller economy on the order of 1.5 percentage points. And that 1.5 percentage points translates into $316 billion of less production, right? That's less production, less consumption, and that's why the economy ends up being smaller. So what drives this? Usually, when the economy contracts, there's one part that comes first, and that's business investment, right? So businesses supposedly are very smart and they're forward-looking, and they can anticipate what consumers are going to do later on. And so if consumers are going to be spending less in the future, businesses are going to start investing less now because they don't need as much infrastructure and as much capacity to be able to supply lower consumer demand in the future. So this drop that we have in production in GDP, most of it is not going to be coming from personal consumption, though we have a decline in personal consumption. It's going to be coming from investment. So I'm going to go back and forth between these two slides so that you can see the difference. Here's consumption, here's investment. Consumption and investment. The bigger drop is in business investments. Business is cutting back because consumers are cutting back, and so businesses don't have to go out and invest quite as much. When we model the Fed funds rate, path one, right now we're at 4.5 to 4.75 as the Fed's target rate. What we have is the Fed going up another 50 basis points in this no recession scenario, right? So maybe the Fed pauses right now and does nothing in its next meeting next week. Maybe it just does a 25 basis point increase. But ultimately, we still think that the Fed would need to increase rates a little bit further to combat concerns about inflation, right? Inflation is turning out to be pretty sticky. If you take just the number from yesterday's CPI report, we're running at about a little over 5% year-over-year inflation, right? So we're far from the Fed's 2% target if you just take the number from yesterday and annualize it. In the no recession scenario, inflation is even stickier. And so the Fed has to continue increasing rates higher in order to get inflation to come down. That imposes even more risk to financial stability. That imposes even more cutting back in lending. In the no recession scenario, we have mortgage rates going up to about 6.75%, which is where they are today. In the recession scenario, we have mortgage rates going up to 7.5%, which is where they were just a couple of weeks ago when we thought the Fed was going to keep going all the way to the 6% rate. We had mortgage rates at 7.2%, and so not far from that 7.5% peak that we were thinking. And we already saw that the housing market was slowing down in response to these higher interest rates. Ultimately, if we get a recession, we think the Fed has to start cutting interest rates to get employment back, right? Employment back down. In the no recession, we still have the Fed cutting interest rates in the outer years because as inflation falls, if it doesn't cut interest rates, then monetary policy becomes more restrictive, right? The real rate of interest becomes higher if the Fed does nothing. So the Fed has to start cutting rates, even in the no recession scenario, in order to maintain monetary policy neutral, right? Not too restrictive, not too accommodative. In the recession scenario, we model the unemployment rate going up to 4.7%. Do you remember Ed Lemer's yellow slopes, yellow western slopes? This is that yellow western slope where unemployment starts going up from its very bottom right now, which is at around 3.6% as of the latest reading. Unemployment goes up basically by 1 percentage point to 4.7%. Still historically fairly low, but the difference, the delta is pretty big, right? And then in the no recession scenario, we get up to 3.8% unemployment, right? That's historically really low. And part of the reason that this is historically very low is that we have lower labor force participation. So even though prime age labor force participation is back to where it was before the pandemic, non-prime age, this is looking at people who are over 55, right? That has really dropped. And we don't expect it to come back. There's been 2 million excess retirements. If you look at the trend right before the pandemic, it happened suddenly. And we don't really see older workers coming back into the labor force. The fact that you have lower labor force participation means that in the no recession scenario, we get to have pretty low unemployment. right? A high share working over a smaller denominator. All right, so some bad news for you. Sorry, Steve. Here's some bad news, right? Is that the Fed does not have a very good track record of combating inflation without causing a recession. So we can go all the way back to 1955. Every single red dot is the Fed increasing interest rates and causing a recession. There are only 3 green dots that are here, and that is an episode where the Fed increased interest rates and did not cause a recession. This is something that happens so rarely that Alan Greenspan got the nickname the Maestro, because he managed to accomplish something that's very difficult to accomplish, which is raising interest rates, slowing down the economy, and not causing a recession. Right now, the odds are 9 out of 12, right? If you just want to take what's on this chart, 75% chance that the Fed is going to cause a recession by increasing interest rates, because that's what has happened historically, right? This is a very back of the napkin approach, but it just means that history is kind of running against the Fed in this situation. On top of that, this has been the most aggressive hiking cycle that we've had since 1983. So the y-axis here, what this is telling you is how much has interest rates increased from the beginning of the tightening cycle, right? So from whatever level interest rates are when the Fed begins increasing interest rates, how much has it increased and how fast? And what you can see, the very red line that says 22, 23 on the very, very left, shows that we've increased at the fastest rate since we started tightening since 1983, right? Silicon Valley has this saying, move fast and break things. Well, the Fed moved fast and it broke something in Silicon Valley. You know, the question is, how much more is it going to go, right? So we are here right now. It could be the case that the Fed pauses after this and we get to maybe one more 25 basis point increase and we're at this level right here. But it could be that the Fed decides to keep going, in which case we come all the way up here, right? This is pretty drastic compared to what we've experienced in the past 40 years. Why might the Fed do this? Inflation, right? How sticky is inflation going to be? So in the no recession scenario, inflation goes away more easily. This means that inflation is more related to supply chain constraints that are easing more rapidly. In the recession scenario, inflation isn't just due to supply chain constraints, it's due to consumer demand, right? And demand being too strong. And if demand is too strong, then the way you cool demand is by pushing people out of work, and that forces people to be more concerned and cut back on their spending. Right? So this is why the recession scenario has both stickier inflation and higher unemployment, because that's what you need in the recession scenario to get inflation to come down. Right? Inflation ultimately comes down to 2.5% in both scenarios. It just takes more sacrifice in the recession scenario to get it to come down. One thing here that's important is that we don't see the Fed getting to its 2% inflation target by the end of our forecast horizon. Right? We basically see it being willing to make a little bit of a trade-off. The difference between 2.5% and 2% is modest enough that perhaps consumers won't really notice. In the recession scenario, we have a big dip in housing starts, right? That's because we have higher mortgage rates. So housing starts go down to 1.1 million per year at an annualized rate in the third quarter of 2023. In the no recession scenario, it stays at this low level, 1.4 million units, but then it starts coming back up. Right? Not quite a big of a decline in housing. In terms of housing prices, so far we don't have to be, that concerned with what happened or having something similar to what happened during the financial crisis. There we had a 27% peak to trough decline in home prices. Right now we're forecasting 5 to 8%. The loan quality of borrowers is just drastically different. Despite some of the rollback of Dodd-Frank, that led to banks like Silicon Valley Bank that were between this threshold of 50 to 250 billion in deposits no longer being subject to the same regulatory stringencies as banks above 250 billion, right? What has changed is that you have tougher mortgage lending, right? This oversight, banking oversight, means that banks are a lot more careful about who they're making loans to. And that means that we don't have the same problem with ninja loans that we had. This is the no income, no jobs or assets that we had during the great financial crisis, right? So this is why we're expecting only, if anything, this 5 to 8% drop between the no recession scenario and the recession scenario related to mortgage lending becoming tighter and housing prices beginning to fall. So just to close, let me show you what this would look like relative to past recessions. right? Every shaded area is a recession. What you're seeing here is both the depth, how far below the zero line do we go, and the width, right? How long were we below that zero line? And what we're expecting in this little tiny red dip is a fairly mild recession relative to what we've had in the past, right? Definitely not similar to what we had during the pandemic, not similar to what we had during the great financial crisis, perhaps more similar to what we had during the 1990s. But as I pass the ball to Jerry right here, what we had in the 1990s was a lot more painful in California than it was for the rest of the country, right? When we think about this almost non-recession that we had in 2000 for the country, it was a lot more painful for tech than it was for the rest of the country, right? So the question now becomes, even if we have what we consider nationally a very small, mild recession, does that mean that it's going to be much more severe in California, given that it's more tech heavy? In case you have questions on Silicon Valley Bank, which I'm sure it'll come up afterwards, one thing to keep in mind is Silicon Valley was a little bit of an outlier in terms of what share of its deposits were retail and insured. It's on the very, very far right here, where it had fewer than 10% of its deposits were below this 250K threshold that's insured by the FDIC. Most of its deposits were uninsured. So not surprising that people would do a run on the bank when they're afraid that they're not gonna be able to recoup their deposits. There is risk to the rest of the banking system, because the same way if you have a hurricane in Florida, right, the cost of insurance goes up. If you have a hurricane at Silicon Valley Bank and the FDIC and the federal government and the Fed comes in and insures all deposits, that means the cost of insuring deposits goes up across the entire banking system, right? So there is going to be spillovers, even though Silicon Valley Bank and Signature Bank, also here on the bottom here, may have been outliers. All right, so with that, thank you.
Thank you, Leo. So as Leo said, the last 4 recessions in California were much worse than the US. And the question that we want to ask now is, as the economy slows, whether it's the no recession scenario with the slow growth or the recession scenario, is it going to be worse in California once again? And so we're going to talk about California, then we'll have a chance for at least some of your questions right after that. And what we want to do to answer this question about California is look at sectors that California is heavier in than the rest of the US. So the example of the 1990, the reason why California had such a deep recession when the US had a mild recession was that California was disproportionate in the production of aerospace goods. And the aerospace sector contracted, so disproportionately California was hit. So we're going to look at sectors in California where there's a disproportionate amount of activity relative to the average in the US and ask, is the contraction going to be greater or less there? And to do that, here's our roadmap, and this is, in honor of our weather. This is the 138 up at Crestline. That's near Big Bear, and there's the 138 going down into the high desert that then turns into the Pear Blossom Highway. I don't think we can get on it today, but we'll get on it virtually with employment first. That'll give us our base. Then we want to talk about manufacturing, leisure and hospitality, and tech. And from there go to housing and construction. And that's going to lead us to our forecast scenarios. So let's jump right in with this. So before being the last couple of times we got together, we talked about everyone leaving California, but California is still growing. Now, those of you who've been on the roads in Los Angeles here anytime soon will relate to this, which says, if people are really leaving California in droves, why is the traffic so terrible? It's the same as it was pre-pandemic. And the reason is that we have churn in California, that the pandemic, and actually it just accelerated trends of changing the things we do here relative to what's being done elsewhere. And we can see the reason for this just by looking at non-farm payroll jobs in the state of California. You can see the big drop here. That's the 2020 recession, the lockdown. And then as you move your eyes from there to the right, you see solid growth in non-farm payroll jobs to where we are 0.4% above our previous peak. So everyone left California, but we have more jobs than we've ever had. That's why the roads look like they do, even when it's not raining. Okay, so we have more jobs, but the thing is those jobs are in different places. And that's represented here. This is sectorally what's happened with employment in California from February 2020, pre-recession, to December 2022, the latest data we have. We're going to get a benchmark revision last Friday, but it didn't come out. So we'll get that any day now, but the trends are going to be the same. And what you see on the right-hand side is other services, that's personal care services, and leisure and hospitality. They haven't recovered. And in many parts of the US, they have recovered. And on the left-hand side, we have our two most tech intensive sectors that have grown. And we have logistics. And then between those two arrows, we've got healthcare. And that's what we were speaking about before, that this is a real growth sector here and across the country. And then we have construction. So we've changed the kinds of jobs that we have. One of the implications of this is that unlike, let's say, Florida or Texas, we still have capacity to absorb workers in the labor short leisure and hospitality sector. So some of those folks who went over to work in warehouses for higher paying jobs are laid off. They may have a place to go. And that's further reinforced in that leisure and hospitality by what I call hope for 2023. So in China, Xi Jinping turned on a dime and said, yesterday we said zero COVID was the best thing. Today we changed our mind, it's not. And it's over with. And that means we're waiting for the Chinese tourists to come back. The Chinese tourists come to California, they come to Los Angeles, San Francisco, they go to New York, they go to Las Vegas, not really any other places. Of course, some do, but most are coming to those places. And in California, this is going to be a couple of million tourists that will be coming in to cities where we haven't recovered in leisure and hospitality or in retail. That's going to buck the trend in the US. So we have capacity to absorb more workers, and we're going to have an increase in demand that will offset at least somewhat the nationwide decrease in demand if we get into the recession. So that sector seems to be better than the US. How about manufacturing? So this is manufacturing payroll employment on the left-hand side. And I say that it's recovered because it's only 0.5% less than it was pre-pandemic. But more importantly is we're doing different manufacturing. And you can see that in this graph on productivity in manufacturing in California. So this is by state. California is in gold, of course. And then we have South Carolina that has a lot of new manufacturing, high-tech aircraft and automobiles. Then state of Washington, then Texas. All the way over on the right, we have productivity from 2019 to 2022 dropping in Arizona and North Carolina. And this is not just a base year kind of thing, cherry picking. We go back to 2015, same graph, more dramatic. So what's happened here? Why is California productivity here up at 13 to 14%, where North Carolina is negative? It's not the people in North Carolina have decided they're not going to work. You know, they're going to go and just, you know, sit there on their phones all day long. It's that the kind of manufacturing that's being done in North Carolina is now lower skilled manufacturing. Important, but it's lower skilled. And what's being done in California is higher skilled, and that's part of that churn in population. It's higher skilled, it's much more technical, and so it's higher productivity. And just to illustrate that and kind of fix it in our mind, here are two of the things that we build in California. The one on the left is the B-21 bomber. going to be built in Los Angeles, minimum $80 billion manufacturing program, but high productivity. One on the right is the Falcon 9, that's SpaceX. That's the kinds of things that we're doing. And importantly, as Leo said, defense budgets are not going to be interest sensitive. These things that we're doing are much less interest sensitive than durable goods in general. Ed showed you the durable goods is worrying. Yeah, so that's appliances, that's automobiles, that's building supplies, that's farm equipment. That's not what we're doing in California. So manufacturing seems to be okay, and the interest rate impact is going to be less than the US on average. What about tech? So we have here the tech layoffs. Ballooning tech layoffs are not the canary in the coal mine. That's the tagline from this CNBC graphic. And if we look at employment in tech in California, it's actually been going up. We're not seeing the layoffs in employment. This is professional, scientific, and technical services, and we're at record employment. What's happening is these large mature firms, who are also global firms, multinational, have been doing layoffs, but they're spread out over the country and indeed across the globe. And here in California, these workers are getting absorbed by smaller, growing tech companies. And there was just an NPR article yesterday about, so this is NPR Seattle, about Amazon's layoffs, and it included interviews with placement firms. And the placement firms are saying, this is really great for us because these small firms have been outbid by Amazon. Now they're hiring all the people that Amazon are laying off. That's what's going on in the tech sector. And in California, one of the reasons for that is that in 2021, we had a banner year for venture capital, and California got the bulk of that. 2022 is here, and Bay Area is first, New York is second, Los Angeles is third, Boston is fourth. Not really what you think of as low cost of living areas or business friendly areas, but lots of funds have come in, mostly Q1 and Q2. So let's look at the fourth quarter. In the fourth quarter, early stage funding holds up. Those are the firms that are hiring. The late stage is at a 4-year low. And so it's those late stage firms, both in Southern California and in the Valley, that are going to have problems in terms of financing. So that's sort of where the stress is. But so far, it looks like tech is holding up, but there is this. And we don't know ultimately what the impact of that's going to be. Certainly the deposits, which were deposits of these venture funds, have now been insured, but we still don't know how this is going to play out. So looks pretty good, but there's a big question mark. Turning to housing markets, here we have on the left-hand side, California Association of Realtors numbers. The drop was 11.8% in the median price. Some of that's compositional, but now it's come back up to 9%. On the right-hand side is the Case-Shiller for Los Angeles, San Diego, and San Francisco. And the average there is a drop of 9%. So housing prices are down. And one of the reasons why home prices are down is nothing is selling. The volume of sales in single-family detached homes in California is at deep recession levels. So everyone's trying to figure out what the interest rates are going to do to home prices before they jump in and sell their homes or purchase a home. And so these numbers are maybe a little bit misleading because these are the folks that can't wait. But we see that in permits. The permits, so this is permits in California, and they've fallen off. If you move your eyes from the kind of left to the right, they're coming up to a fairly high level, and then they fall off in the last few months. But if we look at this on an annual basis, because there is seasonality in this, this is building permit growth. This is a response across the country to these higher interest rates. on the part of developers. And the far left in red at Tennessee, big drop in new home starts, and then Utah, then Colorado. And you go over the right, there are 4 states that had growth, not much, but growth in permits, and one of them is California. And part of the reason for that is that we have new housing products in California, like ADUs that can now be built in single-family detached, single-family zoned neighborhoods, right? And so there are opportunities there, and we're seeing permitting of those and duplexes and the like. And we do a survey with the law firm of Allen Matkins of commercial real estate across 8 markets in California and 4 different types of commercial real estate. And one of them is multifamily housing. What you see in this graph here is the winter survey done in November after interest rates came up of what are the plans of the developers vis-a-vis multifamily housing. And you don't see any impact of interest rates here. To be sure, if interest rates were still very low, it might be higher, but you don't see any dramatic fall off. And in fact, in the last 12 months, our developers, 61% of them built 1 or more new multifamily projects. For the next 12 months, even though interest rates are high, 68% in Southern California are going to start 1 or more new developments. So in housing, it looks like at least part of residential construction is going to hold up better than the US. And we see that in the employment numbers, that this is residential construction employment, and except for the speculative bubble, it is at record levels. Some of that is going to deteriorate, but maybe not so much. And here is non-residential, and you think of office buildings, which is not happening, but industrial is huge, and California is disproportionate in building industrial, which includes warehouses. Interestingly, from our survey, we find that developers are now finding opportunities in retail. So that excess capacity in retail has been bled off over time, and the new housing developments require new retail. So we're going to have an increase in retail, and we're going to have an increase in factories with this new kind of manufacturing that's been coming into California. This is specialty trade that supports those two. It's at record levels. And then finally, heavy and civil, which are things like LAX, the metro in Los Angeles, high-speed rail, and so on, as well as other infrastructure. So that is, again, at all-time high levels. And we have the infrastructure bill coming. Well, the infrastructure bill is passed. We have the money from the infrastructure bill coming in 2023. So when it comes to building, to construction, California is going to do at least as well as the rest of the US, but maybe a bit better. Let's go to logistics. So with logistics, on the left-hand side is seaport traffic. This is the 3 large ports in California, Los Angeles, Long Beach, and Oakland. The top line is imports, and you see that they fall off dramatically. Well, we expected some fall off because we're no longer on Zoom all day long in meetings when we're really not in meetings, but on Amazon buying stuff. So we expected that. But a big part of this is, first we had the threat of a rail strike. Doesn't do you any good to ship goods across the Pacific and have them just sit in the port of Long Beach when you want them in Chicago. The rail strike seems to have gone away, but we still have the threat of labor action with the dock workers, with the longshoremen. And so a lot of traffic has been routed at more expense, routed through the Panama Canal to the East Coast ports. So if you remember, there was a time when you could go from Long Beach to Catalina, just hopping on one freighter to the next because there were so many stacked up. That's what New York Harbor looks like. Right? So we've had this diversion, and as the labor issues are resolved, at least some of that's coming back. And that'll go against the headwinds of consumers buying fewer goods. And so that should help support logistics. On the right-hand side, what you see is domestic goods movement by air. And that's back to pre-pandemic levels. So again, we had that bump in the pandemic when we were buying goods and not services. So it looks like logistics, not going to be a barn burner as it was, but it's in pretty solid shape. So to summarize, what makes the California forecast different this time? Leisure and hospitality, we're awaiting the Chinese tourists. Manufacturing, high-tech, defense, and aerospace, not interest sensitive. Tech is okay for now, but we'll have to wait and see on this one. Construction, we have new housing laws, we have industrial, we have infrastructure, logistics, the return after the strike, and government, which we haven't talked about. State government has a big rainy day fund. So it's not like we were back in the Gray Davis or Arnold Schwarzenegger days. And so that brings us to our forecast. And our forecast is for, unlike the last 4 recessions, this one's going to be milder if it occurs. It's going to be milder in California. It may not even occur in California. Okay. And so here we have employment growth in the recession, that's the R. And in 2024, it's minus 1.2. Because if you remember from Leo's presentation, the recession starts in the 3rd quarter of 2024, but it's really mild there. So that drop in employment on average for the year, it shows up in 2024. Employment growth, no recession, we get solid growth. The unemployment rate does go up in 2024. Again, that started in 2023, but on average, it's 2024 is higher. And then no recession, we have unemployment rates going down to 3.6% by the end of 2025. So some good news for California. It looks like we are at least somewhat insulated from what's happening in the US because of this churn, because of this change in what we do here in California. Okay, so we have 2 scenarios for the US. And last time we did this, we did it again. We asked our forecast team, what subjective probability do you assign for the recession in the 3rd quarter to start in the 3rd quarter of 2023, 3rd quarter of this year or before, but not what's the probability that you see a recession in the 1st quarter of 2024. So it's a 2023, it's our recession scenario versus our no recession scenario. And the answer was, when we average a simple average, 53% Q3 2023, 47% not, but maybe later, but of course there's always going to be a recession later. This is 50-50, this is flip a coin. It is exactly that. We really don't know because we don't know what the Fed is going to do. Now, to be fair, the Fed doesn't know what they're going to do, right? So that's the uncertainty. And we see the uncertainty in these subjective probabilities. We are further apart amongst the 5 of us than we were 3 months ago. So that's where we are, lots of uncertainty. And as Ed and Leo and I have shown you these 2 scenarios, it gives you a guide. It's not pick your own forecast. It's a guide to how to interpret the data as we go forward, and which trajectory are we going to be on or close to. So that concludes our forecast presentation. We also have up here with us our expert on Los Angeles, and we also have Silicon Valley Bank still haunting us. William is here. William is our expert on Los Angeles and also on China, and didn't give a presentation today, but is also here to answer your questions as well. William's been with the forecast for 11 years, received his PhD at the University of Washington, and came to us after teaching in Minnesota. So now we have a few minutes for any questions. So questions from the audience here first. Yes.
We came here with a 50-50 scenario, looking for an answer.
You're leaving with a 50-50.
You're leaving us the same way we got here. It doesn't quite seem fair. We come to you for a little genius, and all you're doing is reaffirming our uncertainty.
So you should be happy about that
I'm
because
happy
it
in
means
general,
it
but
means the analysis that you did is an analysis that we have just reinforced.
thank you.
Okay, other question. We have a question here.
Can I cheat? I have two questions.
Yes, of
One is
course.
for Leo. When looking at your graph in the recession scenario for overall GDP, I noticed that you predict a V-shaped recovery, and I was just wondering if you can extrapolate on why you're predicting such a swift recovery. And then I have another for Dr. Nicholsberg about a potential recession in California, or even just a mild growth in California. Because of those factors where you're showing positive indicators in high tech, the high tech economies, could we in fact see a tale of two recessions where higher earners in California do relatively well, where lower earners in California don't do so well?
Okay,
So-
Leo, you're first.
Yeah. So to your first question, I think we have a lot of positive tailwinds in our economy, right? One is that we have an aging population that's going to require healthcare services. We have the need to invest in climate change infrastructure, right? So we're already making a big push to electrify. We have to revamp infrastructure, some of it related to climate change, which is, as there is more climate change risk, we're going to have more potential disasters, which means that we have to rebuild more houses. We have to rebuild more government buildings. We have to rebuild more roads. All of this from the perspective of economic growth is a stimulus to the economy, right? Put on top of that, higher and increasing defense spending. So these are the positive tailwinds. What the Fed is trying to do, and you normally see this with interest rate driven recessions, is they're trying to make you stop by today and delay some of your purchases to tomorrow, right? Just long enough so that not everyone is trying to buy everything, at the same time all at once, and drive inflation high. And so this is why we think it'll be a relatively fast recovery, is the Fed is just trying to get you to, for long enough, delay your consumption to a later part in the future, and then add on top of that all these positive tailwinds that we seem to have in the economy.
Can I add one thing? Yeah. One thing I would like to add to Leo's comment is we found the manufacturing sector actually had a fundamental change over the past several years. So if we look at a recession in 1990, 2001, and 2008, what happened is in the recession, the manufacturing in the United States shut down and most of them moved to Asia. But this time it didn't happen. In 2020, we see this manufacturing bounce back very quickly because the mindset had changed. From Trump administration, from Biden administration, they emphasize this make in America. So that is another thing I think add to this tailwind.
Yeah. So on California, we saw that bifurcation certainly in the last recession, but in the last couple of recessions, where lower income Californians were hurt much worse than higher income Californians. Some of that has resulted in outmigration, and some of it has resulted in a change in kind of the way we do things and how people are paid. But the sectors that are on average, low income sectors, leisure and hospitality, other services, certainly some parts of healthcare and in retail, they're sort of at a bottom, and we don't really expect to see much erosion there. Certainly not what we've seen in the past. So in some sense, the fact that California is very expensive has changed the way in which we do those activities, because we have to pay people more to be here in those sectors. So will it be differential across sectors and differential across socioeconomic classes? Sure, it always is, but I think not like before. Okay, other questions from our in-person audience? So we have Slido, and we have some of our brilliant MBA students from the Healthcare Business Association here curating them. Is anyone asking questions on Slido? Or another question from the in-person audience?
Yeah, obviously SVB is a curveball here, but I think the Fed has done some extraordinary measures to stabilize that situation with insuring all of the deposits, giving them the bank facility that collateralizes the securities they had at our par. So yeah, I feel good about that right now, but for the banking sector, obviously CRE is a big asset class. And can you comment on office specifically? I believe Brookfield just gave back a $200 million portfolio of office, and I assume that more of that is to come.
And I think your assumption is right, that office building, well, new office construction has really wound down. And there are a number of office buildings that are either in default or close to it. And the question is, what happens with those? Some are going to be repurposed. It's not going to be a huge percentage. Some older office buildings might be torn down and then that space used for mixed use or some other use. And ones that are financially in trouble, but can't be repurposed easily to make a decent rate of return, will go back to the lenders and there'll be a capital loss. What really affects the economy and the growth in the economy is new construction. And so for a while now, we haven't really had much in the way of new construction of office buildings. So that we don't expect to change. With respect to the banking system, that is problematic, right? So there's a large amount of office space that is at or close, well, let's say is stressed. And we don't know how stressed. There was a study by Goldman that said, you know, the banks have plenty of reserves for this, but maybe not all banks.
I'll agree with you on I feel comfortable with the bank term funding program that the Fed put into place. Where I'm worried is that the Feds are also responsible for bank oversight. And so there's both the Dodd-Frank stress test that the largest banks have to do, but there's just the regular oversight side, right? And when you read reports that KPMG that recently audited SVB missed some of these risks, when you read that the San Francisco Fed and its oversight responsibilities missed some of these risks, that's where I'm wondering, well, what else has been missed, right? What else are we not looking at? And so, we've essentially seen some of the cards be laid out on the table, and that just suggests that we weren't as vigilant in terms of regulating the banking system as we could have been.
Yeah, and just to further on that, because I think that's exactly correct, the non-bank financial sector, has some real opacity to it. The banks, even though the oversight maybe has not been what we would like it to have been, there the oversight's not there. And what we don't know, which is important, is the extent to which that very large non-bank financial system has systemic risk in it that would impinge the banking system. So that is an unknown. I would imagine that the Fed is rapidly trying to dig into that, but that's something for us to keep our eyes on, because that is a risk in the forecast, to be sure. Okay, we have time for one more question. We have one more question. Or did we answer all of your questions?
So we have some questions.
Okay, go ahead.
So we see many companies are waiting to see on decision to spend because they are very concerned about the future. So what factor do you think will get them to start to spend?
Yeah, so some good news and some bad news on this, right? So some of the good news on this is that businesses, especially in leisure and hospitality, struggled so much to hire over the past year that they haven't been laying off quite as much as they normally do, right? Now, is this labor hoarding or is it because the demand is actually there? We'll see, right? But we saw 517,000 jobs be added in January. We saw 311,000 jobs be added in February. A lot of this is net jobs, right? So you're not laying off quite as much and you're still adding jobs in leisure and hospitality. Part of my concern is that if you're not laying people off seasonally right now when the economy tends to slow down in January and February, does that mean you're not going to be hiring people in May and June when the economy tends to speed up again in the summer months? I think what a lot of businesses are going to be looking at is what are consumers doing, right? And that also depends on what is happening to unemployment. If unemployment is pretty low and unemployment is staying fairly stably low, then consumers might actually feel confident in going out and spending. When you ask consumers how they feel about the economy, what they say is, I feel terribly about the economy. But then you look at retail sales and they're still going out and spending. And so you can't, base it all on University of Michigan consumer sentiment surveys. I think businesses are focused more now on what is happening to retail spending, and that seems pretty positive. What's happening to initial claims for unemployment, that's still fairly low, and what's happening to unemployment, still low. And all of that means that the consumer is still empowered, at least during the next 6 to 8 months.
Yeah, so a final thought on that if you look at the data on sentiment and on consumption, it appears that we Americans feel good and we go out and we spend. We feel bad and we go out and we spend. So it's not the sentiment, but it is the activity that you should be looking at. So we're going to take a 10-minute break, and then we have incredible keynote and panel to dig into this. One of those sectors, it was the second one that I showed in California, has been growing very fast, but is in flux, in change right now, the healthcare sector. So 10 minutes, and then we will start again with our keynote. Thank you. Okay, now it is time for the second half of our program, where we're going to take a deep dive into this very important sector of our economy, that of healthcare. And we're going to start with our keynote, and our keynote is going to be a conversation with Professor Terry Kramer. Professor Kramer studied here at UCLA and at Harvard, had an incredibly successful career in technology and telecommunications, was appointed by President Obama as an ambassador in telecommunications to various events, is a full professor here, and is also the faculty director of the EASTON Technology Management Center, and teaches in our MBA program, Technology and Leadership. And so with that, let me turn it over to Terry. Oh, by the way, the EASTON Institute is our co-sponsor and partner for this conference. Terry.
Remotely. Now, one of the interesting things about technology is you see it affecting almost every industry: manufacturing, retail, transportation, and healthcare is no exception to that. Whether it's the use of data in diagnostic capabilities, whether it's remote access via the Internet of Things and connected devices, whether it's digitized healthcare records, et cetera, there's a variety of opportunities out there. All of these present some fascinating leadership issues. Leaders thinking about different business models, thinking about the use of technology, thinking about impact on patients, cost, et cetera, et cetera. So during the conversation today, there are three things that I'd like to talk more about and ask our guest speaker. One is about where is healthcare going to be going, specifically from the use of technology. What is the role of technology? Second area is going to be in the area of cost, outcomes, and also cost of healthcare. And then a third area is talking about competition, because there's been some very interesting announcements recently about new players in healthcare. A couple of statistics when we start talking about cost. total amount spent on healthcare in the US 2021, about $4 trillion, about 20% of GDP. When you look at it on a per capita basis, the amount that is spent here in the US is about twice that is spent in most other developed countries. A variety of efforts to help control costs have happened in Washington. So most recently, the Inflation Reduction Act, which allows many providers to negotiate, especially Medicare related, to negotiate the cost of prescription drugs. Also, the Affordable Health Care Act, which seeks to put limits on the annual maximum for in-network out-of-pocket costs. A couple of examples of where technology is being used today. So if you look in breast cancer care, the use of artificial intelligence is allowing mammograms to occur basically 30 times faster with 99% accuracy, eliminating the need for many biopsies. The use of virtual reality. Stanford's doing a variety of tests today on pain management using virtual reality, getting the mind to focus on other things than pain and anxiety. There's also the use of virtual reality for physicians and surgeons with certain procedures, specific ones, kidney tumor surgeries that have resulted in shorter operating time, less blood loss during surgery, and shorter stay in hospitals. And then a final fact I think that's interesting on the competitive front is Amazon has announced its own interests in healthcare. So Amazon just recently closed their $4 billion acquisition of OneCare. Basically, this was their effort, One Medical Group, that is their effort to move into both virtual and in-person care. And a lot of what they've talked about is creating a new changed patient experience. There are a variety of other big tech companies that are moving into healthcare. So with all of that as context and backdrop, let me tell you a little bit about UCLA Health, because we're very fortunate to have one of the pioneers, the leaders that's really looking at the future of healthcare. First of all, the size of the organization. 4 hospitals on 2 campuses, more than 200 medical practices throughout Southern California. They also have, as part of their organization, the Geffen School of Medicine. UCLA Health itself is rated #1 in Los Angeles, #1 in California, #3 in the nation overall. This is all done by Survey US News and World Report. Hospitals and healthcare networks have rated Ronald Reagan UCLA Medical Center as one of the most wired hospitals in the nation. One of the most recent efforts at UCLA Health in the area of innovation has been their new effort, Tequity Accelerator. So this is a partnership with UCLA Health's Biodesign and Bioscience LA that allows innovators to start thinking about future areas of innovation to build new ventures that can serve not only UCLA, but the broader nation. I can't think of a better speaker than UCLA's own Janice Spizo. She's got an incredible background. She's the president of UCLA Health, the CEO of UCLA Hospital System, the associate vice chancellor of UCLA Health Sciences. She's a nationally recognized academic healthcare leader. She has more than 30 years of experience, oversees all operations of UCLA's hospitals and clinics, as well as the regional outreach strategy. Before UCLA, she spent 22 years at the University of Washington, their School of Medicine. She was there the vice president of medical affairs. She's received her master's degree in healthcare administration and public administration from the University of San Francisco, bachelor's degree in health sciences from Chapman College. She earned her RN at the St. Francis School of Nursing. She's written a variety of articles, book chapters on healthcare leadership. She's received numerous awards, and I'm not going to list all of them, but there's a huge number. Modern Healthcare's top 25 most influential women leaders in 2019. The Los Angeles Business Journal's 500 most influential leaders in Los Angeles in 2020. So an incredible background here. I'm going to plan to ask President Spiso a variety of questions about healthcare and competition, et cetera. We'll then go to a Q&A. As a reminder, we'll use slido.com. So slido.com. You can either enter in your own question or you can upvote one of the existing ones. I'll endeavor to pose the most popular questions. The event code that you enter is SPISO, S-P-I-S-S-O. SPISSO is the event code on Slido. So please join me in welcoming Janice. Janice, it's a pleasure to have you here. And I always like to start when we have a luminary leader. It's just to have you start out talking a little bit about your leadership journey, the types of experiences you had, and how they informed your view on healthcare, how they informed your view on leadership.
Well, thank you, Terry. And first of all, thank you to the Anderson Forecast for having me. It's always a pleasure at UCLA Health to really partner with the fantastic Anderson School of Business, and really want to thank Dean Bernardo for all of his support to us at UCLA Health. So I've been in healthcare now over 35 years. I actually started my career as a registered nurse in critical care at the University of Pittsburgh. And in that time, really got to experience what is our product in healthcare, which is the patient care experience. And after moving to California, where I wanted to complete my master's degree, I started working at the University of California, Davis. Spent 12 years at the UC Davis, starting as a charge nurse, then working my way up to a nurse manager, then to a director of nursing over critical care, emergency trauma, and burn services. Then moved to Seattle, Washington. I was recruited by the University of Washington to be the chief nursing officer, and spent 22 years at UW-Medicine, starting out as the chief nursing officer, then eventually becoming the chief operating officer of Harborview Medical Center, then becoming the CEO, and then becoming the health system CEO over 4 hospitals, the neighborhood clinics, the airlift program, and did that for 8 years before I was recruited to UCLA, where I've been now for the past 6 years. And I think really some of the advantages I've had in my career, starting with the ability to work at amazing academic medical centers where you're in that constant state of learning and discovery. I think the unique thing about academic medicine is not only are we working to provide that excellence in clinical care and patient care, but we're also training that next generation of healthcare professionals. And you get to work with every healthcare professional, doctors, nurses, social workers, pharmacists, every type of therapist. And then we're conducting that leading edge scientific discovery and research that really brings forth new cures and treatments for patients. And we're in that environment where we can see things go from the beginning of a clinical trial and everyone working hard on studying how to treat or cure a disease, to actually delivering whatever that new novel therapy is to patients and seeing remarkable outcomes. So for me, having started as a nurse, and when I think back 35 years ago, there were patients with certain types of cancer, certain types of neurological issues that didn't survive. And now where we are, and you see those patients surviving and thriving. For me, it's really exciting, and it really makes me appreciate the value of those investments in research and discovery.
Excellent. And on that topic, Janice, give us your kind of state of the union in healthcare.
Yes.
When you look across healthcare, what do you see as kind of the shining lights and great progress? What are the areas of concern? If you were to kind of rate where things are, what would you say?
Yes. So it's a very interesting time in healthcare, as you can all imagine. The previous presentation, everything you hit on impacts one part of our business or another. So, but I'm going to start with really where the optimism is in some of those areas that seem really dark right now. So first of all, just kind of the state of the landscape across the country in not only academic medical centers, but in private medical centers as well. Across the country, really about half the hospitals are losing money right now. In our own state of California, many, many challenges. We may see up to 12 hospitals close. Those are mostly smaller hospitals in our state. So that's a big issue because we have critical needs and access to care, as many of you know. Now with that, I think there is some hope on the horizons. First of all, we got through the COVID-19 pandemic and learned a lot. But now that the pandemic is really quite manageable, one of the things we've seen is our costs are really outpacing revenues pretty significantly. We were able to get through the COVID pandemic with a little bit of support from CARES funding, and that kind of helped hospitals really tread that water. But the problem now is we're all busier than ever. We're overflowing. We need more resources and more capital investments to really care for the patients presenting to us. And we're losing more money than ever from that equation. And a lot of that is due to the inflation, the cost markup that we're seeing on goods and services, pharmaceuticals, the cost of labor, and particularly when hospitals are so busy, you have to use a lot of premium high cost labor, and those dollars really have been significant. And then really the other issue is tremendous pressure from the commercial payers on reducing their payments to us and rising numbers of patients on governmental programs, Medi-Cal and Medicare, that don't cover the costs of care, right? So we need that balance. We need enough commercial payers to really help us make up some of the deficits in that. And there's been tremendous pressure to really roll back payments. So that's the difficulty and the challenges. Now, I think one of the things and one of the challenges for leadership is during that time when we're seeing all these things that look like, you know, depressing news, we have to also be investing in our future, right? Because growth in healthcare and our ability to expand and care for more patients really, in the long run, really serves the community better and can help us weather the financial crisis by the ability to serve more, bring in patients from all walks of life. And that's really important, particularly in California or Los Angeles, where 4 million people are on Medi-Cal in Los Angeles, right? So the good news with the Affordable Care Act is people who were uninsured, as many of you know, we were an expansion state. We got people enrolled in Medi-Cal. But the challenge with that is it doesn't pay us. It's better than getting nothing, but it doesn't really cover our costs at all. And with so many people to care for on that, we need enough of a commercial mix that allows us to stay financially viable. And that's a challenge in a competitive healthcare market, particularly when we have organizations around us that don't have that same mission all the time to serve the underserved or to serve programs like mental health, inpatient psychiatry that really lose money but are a very much needed resource in the community. And UCLA Health has been really investing in those resources to expand services. During the pandemic in 2020, there was a hospital that was closing in the mid-Wilshire area, Olympia Hospital. That hospital had made the decision to close. We purchased that campus, and we're now in the process of about a $475 million capital investment to make that campus a state-of-the-art facility for mental health, behavioral health. We'll be adding a total of about 139 beds, inpatient and observation, a psychiatric emergency department, and an outpatient facility. And as many of you know, here in Los Angeles, one of the most vulnerable populations are patients with behavioral health and mental health issues. And the numbers of hospitals that have closed beds over the past decade has been pretty dramatic. So we're one of the few providers left in that area. But when you step back and think, how do we finance that? How do we keep investing that? It really takes, you know, a lot of creative financing, a lot of support from the community, and certainly things like philanthropy have helped us.
Yeah. Jenny, so let me dive deeper on your kind of state of the union. Obviously, we're at the Anderson School of Management. We love to study business success, strategy, industry, et cetera. You know, number one, we talk about how healthcare costs here are much higher than outside the US. You also have talked about some hospitals losing money, smaller ones. Is the root cause of the problem a national one? That basically the way the whole system is set up is problematic? Is it the players that are in there are actually subscale, not executing well, et cetera? When you look at kind of the issues that have driven this, how much of them are national and systemic in nature? How many of them are strategy and execution of the enterprise?
You know, I think it's all of the above. First of all, the way healthcare financing is done is really chaotic. And a lot of it doesn't make sense when you'd compare us to any other business industry, right? where different types of insurers or groups pay us different rates. It just, to make that all work, it really takes, a constant balancing of things. The other issue has been, there have been parts of the healthcare sector, the few parts that are somewhat profitable that others have gone after, right? So when you're a health system like an academic medical center and you provide everything from that preventative care all the way through the most complex quaternary care, you're training that next generation, you're doing the research and discovery, right? You really have to fund all elements of that. And we have seen some disruptors come into the market specifically, and I know we'll talk about that later, about specific segments of the market. The other challenge is, the growth plan, right? And so I think right now hospitals are really looking at what type of growth plan do we need? How big can we afford to be, right? Mental health is a good example. We could have built a 1,000-bed mental health hospital, right? And filled it up. There's absolutely no way to finance that. And so it is really causing us, I think, certainly locally and nationally, to really look and say, what is our strategic plan for growth? How do we have a growth plan that meets the community needs, but also has a viable financial picture?
Yep.
In a dynamic environment that keeps changing.
Excellent. If you could wave a magic wand before we get into the kind of inside healthcare and kind of saying here are all the challenges, but just say, listen, you could take 3 actions to improve healthcare outcomes, reduce costs. What would those things be? Are they kind of national policy issues? Are they issues on cost and how suppliers are managed? But just say, what would be those kind of 2 or 3 big things?
Yeah, I think on cost, stepping back, and again, within healthcare, we do have to look internally and say, how are we treating patients? What supplies and services are we using? What are we doing to really come forward and deliver that value-based care? So at UCLA Health, we've been spending a lot of time on that and looking at the analytics, right? This is where our data mining really comes in to help us. We have a huge department of population health that is also studying patients, really looking at saying, what is the best value-based outcome? How do we guide therapies? How do we define care paths that really lead patients to the best treatment to improve their outcome at the best time and at the best cost? So it's also made us look at where do we provide services, right? How do we move a lot of traditional services that were in very high cost locations to lower levels of care, definitely expanding our outpatient portfolio. And we've been doing a lot of work on that. For example, I can think, just 6 years ago when I came to UCLA Health, patients who were getting a blood and marrow transplant, almost 100% of those patients were admitted as an inpatient. Now we're well over, 50 to 60% have that done as an outpatient, right? So those advances in therapy allow us to continue to do more things cost effectively. And this is where I am really excited about some of the things that we're seeing in research that's leading us to better cures and better outcomes. Just a few years ago, UCLA Health had done a lot of the leading trials on CAR T therapy that for cancer care, a chimeric antigen receptor therapy. So that's taking the cells out of the body, really engineering them to be the fighter against cancer instead of using chemotherapy drugs. And so we've had tremendous breakthroughs in that. Now with CAR T therapy, people with, what was felt to be end-stage blood cancer are now getting cured, and they're in the hospital a short period of time. And all of that was really led, by a lot of the great science here at UCLA, Dr. Ari Beldegran, who then started Kite Pharma. Right now we have, if you look at last week's Los Angeles Business Journal, it really featured the leaders in immunotherapy. Dr. Antonio Ribas from our Johnson Comprehensive Cancer Center is really working on a lot of additional therapies that will really change that. So that's where I think, going forward in the future, that's where those research breakthroughs and discovery are really helping us change medicine and bend that cost curve.
Yeah. Let's talk now more about technology, because we're starting to kind of get into that. And, the message of a lot of big tech companies is, at their best, they are democratizers. They're able to automate certain activities, they're able to create better insights that drive down costs. They change the idea of place, that you don't have to be in a physical place, you can be anywhere, and ideally create better outcomes because of the precision of data. at a macro level, before we talk about the specifics, do you buy that argument that actually technology can do that same thing that we've seen in transportation and retail and a bunch of other areas in healthcare, or no, healthcare is unique in the following areas?
No, I definitely think the digital transformation in healthcare is here. I was just reading last week, the Blue Ridge Academic Medical Center group put out their spring 2023 edition is really all on the digital transformation in healthcare. And healthcare was slower than a lot of other industries to adapt. When you look at what's happened at streaming and other things, how fast there's been, implementation and adoption. The complexities in healthcare is what I think has driven some of the pace. But I will say things really accelerated during the pandemic. So first of all, we've all been investing in electronic health records for years, hundreds of millions of dollars. That's definitely shown improvements in patient safety, the ability to really look at data longitudinally. But we weren't really using all of the tools that electronic health can do. So we always had the ability to do telemedicine, telehealth visits. And prior to the pandemic, we would maybe do 150 a week. There really wasn't a lot of provider interest in doing it or patient interest. Once the pandemic happened, we rapidly accelerated and did hundreds of thousands of telemedicine visits. And now we know telemedicine is here to stay for a portion of patients who really don't need to come in for the physical exam. So we've had great provider acceptance, great patient acceptance. Additionally, we learned that we could do a lot of other things in communicating more effectively with our patients, with the ability to use artificial intelligence, a lot of the new technologies. So when the pandemic hit, we started, as you can imagine, getting hundreds of thousands of calls into our call center, just overwhelmed. So one of the things we did is we enabled a chatbot on our website, so people could really get in there and ask some of the questions. And we were really able to reduce the calls by driving patients to our website and really getting great information. We got a lot of positive patient feedback on that. When we come into the organization and we look at how technology has enabled us, so over the past decades, the use of robotics in surgery has led to much greater precision, much better patient outcomes, less trauma to the tissues, less pain management post-op. We're doing a lot now with AI tools. Now that we have this huge data warehouse of electronic health information on patients, millions of patients in our system, we're actually able to look and start mining data and predict risk. So for example, one of the things that is going on in our Department of Anesthesiology and Surgery is we're really looking at predictors of when patients have anesthesia or other complications after surgery and saying which patients really need that pre-anesthesia visit or not to go forward, and how do we better plan on that. Additionally, we've adopted a lot of AI tools in some of our routine business functions. So for example, hospitals, as many of you know, have very strict HIPAA requirements for patient privacy. So we used to always have to be doing routine audits of who's going into the electronic medical record looking at patients. Now we use an AI tool that actually looks at that, right? No staff time involved, and produces a report every month. So we know anyone who is in a record that shouldn't have been. So things like that continue to add efficiency. We're using robotics in supply management, a lot of robotics in lab medicine. So those are things, as we go forward, I think will continue to lower the cost of care and also improve the quality and safety.
Yep. Let me go through some of these individually because they're kind of fundamental areas of technology. So the use of data, artificial intelligence, is the frontier there. Diagnostic accuracy goes way, way up because you have much better insights. You're able to drive down unnecessary tests like the example I gave you, and all of a sudden you've got better outcomes, lower cost. Is that kind of the narrative on data and artificial intelligence?
So I think that's the goal. The challenge in healthcare is how you take that data and make that information that's available at the point of care, right? There are a lot of things and tools that really are retrospective, but how do we get that intelligence, if you will, into the hands of the doctors and nurses at the point of care at the time they're delivering it, right? And that's where I'm most excited about some of the things that we're doing. And I know Jennifer will talk about this later in our innovation program, in our biodesign, because we're really now taking our group of clinicians who have these great ideas and really investing in them to say, how can we partner with tech companies and really build that tool or solution that will help? I think the challenge is if things are designed without that direct clinical connection, we sometimes miss the boat or don't have the same type of utility that we could have.
Yeah.
So that partnership between healthcare, tech, business is so important in that.
Yeah, we had the chief data officer for United Airlines speak, Linda Jojo. She was incredible. And obviously, you're not an airline, very different industry business, but she talked all about getting data on their passengers that flew a lot on them, but yet had a bad experience, a canceled flight, something else, and taking that data and putting it in the hands of their flight attendants and their gate agents, so that when somebody's coming in specifically, they can take care of them in a very customized way. Is that the model, or is the context so completely different in an airline that you really can't say that's what we're looking to do?
No, that's exactly, and an analogy we use on that right now in our ambulatory clinics, we try to do a real-time survey. So, historically hospitals have, after patients have a visit, they mail out surveys, patient fills out a long survey, it comes back. Months later, you look at it, you try to see what the problems were. We try to now, through text, send the patient a message right at the end of the visit. How did everything go? And give that like 5 quick questions, and then allow them a chance right at that point of contact to talk to a manager if something didn't go right. We want to do that service recovery right there rather than after the patient has left us. So again, tools and technology really help us do that.
Yeah. Let me ask you another area of technology innovation, the Internet of Things, connected devices.
Yes.
How transformational will that be in healthcare that says people don't have to come to a hospital, they don't have to go to a clinic, monitoring people after a surgical procedure, getting preventative information so people don't have to go into is that transformational, or that's down to number 8 or 9 on the list?
It's been helpful in certain areas. So we use a lot of remote monitoring in some of our complex patients. So patients who've had a solid organ transplant, our cardiac patients, a lot of our liver patients, people who come to us from long distance, we try to use remote monitoring tools for those. The whole concept, I will say, of, ICU at home, those types of things, those have really had some fits and starts. The thing that is tricky about that is not everyone has the same type of home environment. Not everyone has the same resources in the home. Not everyone has the same support system to do that. So it's quite variable, and the ability to kind of replicate that in more of a commodity type function has been more challenging. But we continue to look at remote monitoring, remote technology as ways to decompress our healthcare system that is tremendously overcrowded, and also keep patients really functional in their home environment.
Okay, good. Let me ask you one other area. There's a lot of talk today about chat GPT, generative AI. You talked about chatbots, et cetera. Tell us about how you think that would change the future of healthcare. Would it eliminate 50% of kind of the human interaction, or that's too pie in the sky?
I think it's something that's generating a lot of discussion right now. We're fortunate at UCLA Health. Through UCLA, we have a Department of Computational Medicine led by Dr. Eleazar Eskin, who also partners with us on the health system to look at how we can really move forward AI and a lot of these other technologies. So we are looking at different pilot projects. We feel there definitely is a future there. We don't know what that future necessarily looks like, but we know it is not a tool and technology that we can, simply ignore. And if there are advances that bring forward that improve quality, safety, service, and outcomes, I think healthcare will be definitely interested in adopting.
Excellent, excellent. We're going to go to Q&A in a minute. So again, if you've got any questions, slido.com. The event code is SPISSO, S-P-I-S-S-O. Let me now move into competition. We just had Neil Lindsay speak, the new head of Amazon Health. By the way, his background, he used to head up Prime for Amazon. He doesn't have a healthcare background, which I found fascinating. And he was a very interesting speaker because I said, you know, broadly, what are your ambitions in healthcare? And he had to be fairly tight-lipped about exact offerings. But he said, listen, we're going to be focusing on the 3 platforms that Amazon thinks about. They think about value, they think about selection, and they think about convenience. They obviously operate an incredible platform, matching buyers and sellers of all types. They run an incredible supply chain management organization, negotiating, getting best costs. They are heavily, heavily data oriented. When you kind of hear that background, does it scare you to death and say, oh my God, this is the change of healthcare, or easier said than done and not too worried?
Well, I might hire him for marketing because I like the way he's done that. But I'd say the 3 things are probably pharmaceuticals, supplies, and money, right?
Yeah.
So let's step back. And I see Dr. Mark Grossman, who runs all of our community clinics here. And
Yeah.
probably every month we're looking at someone writing us something about, is it One Medical? Is it Amazon?
Yeah.
Is it, you know, all of these different startups, kind of that, you know, what used to be called that doc in the box model. But stepping back, so they're definitely trying to disrupt portions of the care. And again, this is where, you know, stepping back, there's really not a lot of money in primary care. So I don't think they're going after it for that. They're going after it for some of the downstreams.
Yeah.
But stepping back, and we've had, you know, for example, we've had One Medical in our market. Has that impacted us at UCLA Health? I would say that's been a resounding no. Our clinics are overflowing and we keep opening more clinics and we're busier than ever. And I would say why? And I would say because of the informed consumer. So why would you pay a fee, right? A membership fee to come in for primary care, and, you know, then you're getting your insurance billed and everything. When you can get that for free at UCLA Health, you don't have to pay a fee to use our primary care. We have over, you know, 260 clinic locations. We have immediate care. You can call us for a visit, you can walk in, you can book a visit online. And not only do you get that primary care, but if you need any secondary specialist, you have immediate access to our thousands of specialists. If you need hospitalization, you have immediate access to our hospitals. And if you need any of that complex tertiary and quaternary care, we're the provider. And also the place that for people who have anything serious, not only are you getting this world-class team of experts, but with connections and research nationally and internationally. So they're talking all the time with experts over the country about the best ways to treat and manage your disease. So I think when we think about healthcare, we try to think of that as a continuum of care, right? From the preventative primary all the way to the most complex. And when you're in UCLA, our system really wraps your arms around us. You know, you can come into these episodic ones, but if you need a specialist, they're calling and referring to us or someone else in the community. So I do think the more informed consumer understands that. Now, it's caused us to be more accessible, right? So we've said, if it's same day access, we've got to work on that. We've got to expand our clinics. We've got to expand our immediate care centers. One of the things during the pandemic, since the ERs, emergency rooms, were overcrowded everywhere, every emergency department, including ours, we started opening and expanding hours of our immediate care centers. So we now have 12 available throughout the community. So it's making us more responsive to the need. But long term, I think, you know, a lot of these companies can afford to make these big investments in these big buys. If they work, they work. If they don't, they don't. And they've got the funds and capital to do that. But I'm not that concerned about that, I would say.
Let me ask you a couple more questions. I love this topic, by the way. If the One Medical Group is an opening salvo, it's not going to be their end game, but instead to set up a platform where, in essence, they're going to say, here are all the providers for XYZ tests. Here's the cost. Here's the availability when you can get an appointment, and here's a rating of some sort on quality. Similar to when you buy something on Amazon, would that change your response? Would you be more worried because all of a sudden there's kind of arbitrage play? There's data transparency on this.
And, you know, we're always looking at that. So we, you know, we have price transparency. We're always looking at our costs because it's the first thing the payers
Yeah.
ask us about. And we're always looking at patient satisfaction. And in order to compete in this market, we have to perform on all of those.
Mhm.
So again, we're always looking and watching, looking at what the competition is doing and how do we need to really change that. And, one of the things I will say, as busy as our system has been, our staff's ability to really deliver that clinical care with expertise and also these amazing acts of kindness has made us a leader in patient satisfaction. And so every day as I look at our facilities and they're overcrowded and people waiting in the emergency department who bypassed other ERs to come there, when we talk to patients, it's because they know they're going to get great care.
Last question on this topic, because again, it's a fascinating thing about the chess game and how strategy plays out. Is there an argument here that you need lower costs because much of what you've talked about is driving costs down? They're going to be a winner. You're going to be a winner. But actually, the people that get disrupted here are the players that aren't doing as good a job in healthcare. The costs are high, availability isn't good, et cetera. Is that how this might play out?
I think it may play out that way. And also, too, we do need more access. So them having other people in our market doesn't hurt us. If anything, they refer us almost all of their specialty care. But I don't think it's a bad thing having different people in the market. I do think, though, because of some of the issues we're having in healthcare with access for certain types of services and population, we do need to work better as a healthcare community to say, this is truly what's needed in the community, right? You don't see anybody going after mental health or a lot of the, underserved needs. And we have tremendous health equity issues in Los Angeles, and we would love to see more partnership in that work.
Yeah, excellent. Makes sense. We've got a whole bunch of questions. Let me ask the most popular ones first. What is UCLA Health's approach to building versus buying healthcare innovation?
Yeah, really great question. I think we've recognized that many times we can't build things faster than we can partner and buy things. So it's definitely a mixed model. There have been amazing things developed. And now we do have really a great engine working with TDG on campus, the Technology Development Group. So when we have great ideas, we can bring them to market faster. But we're never going to be able to do it all on our own. So we do love the ability to partner with businesses in the community. That's one of the reasons we've made investments in our innovation program so that we can have that platform to do that faster and better.
Excellent. Another question. One barrier to improvement in healthcare is the lack of data because of HIPAA. Do you foresee any changes to regulations there?
Yeah, one of the things, when we are looking at our data mining and our big longitudinal databases, most of that is using de-identified data. We can still get a lot of the trends and things we need from that. On the regulatory side, we certainly haven't seen any trends going towards relief in that.
Excellent. Let's see here. You mentioned money and financing being a challenge. Can you elaborate on that?
Yeah, I think, as I mentioned, we need more facilities and resources to take care of the growing numbers of patients, right? So hospitals have to keep making those investments in buildings, in beds, in capital. The cost of building in California is very, very high, right? $4 to $5 million a bed. We also have to be continuing to make those investments in technology. And with our margins shrinking, right, that becomes more and more difficult. But I think one of the things that you have to do is look more at the long game and look at what you can weather over 4 to 5 years on the finance side, on how low you can get, how your days of cash you can tolerate to make those strategic investments that will help us in the future.
Okay, excellent. And then let me just ask a couple more questions here. On AI, there's obviously a lot of concern about bias in data that can actually create bad outcomes. How do you think about that issue? How do you prevent kind of bad use of data, bias in data, against some of the benefits you talked about a minute ago?
Yeah, I do think that is where some regulation needs to come in and some oversight. When you think about it, we haven't had much oversight in the tech industry, right? Even if you look at, some of these algorithms that were developed, right? When, take social media, we know what that's doing to our youth with the influence of social media and the rise in depression and anxiety. You can actually track it from 1997, from when the iPhone was released, the increase in depression and anxiety in our youth. And so we knew those algorithms were kind of leading to some of those results, and yet those things have continued. So I do think this is something that has to have guardrails on it, how data is used, what you're doing with that data and information, how it's guiding treatments, how it's guiding access to care, how it's deciding choices of what patients are covered, what patients aren't covered. So I think without some regulation and guardrails, I think that's one of the big concerns of
That'll be
the
an
public
issue.
is the dangers.
Good. Let me ask, before I do a wrap up here, let me ask the last question. I'm going to broaden it a little bit about, how do you see improvements, especially in driving costs down? Would increasing the number of healthcare providers, increasing the supply side help a lot here? Or would it be larger players that can be have more scale, drive down per unit costs? How do you see that issue?
Yeah, again, I think that's a combination. Right now, we are having, a significant shortage, not just in healthcare workers, but in all the support services that really you need to run hospitals and clinics. So that labor shortage is really impacting it. And so one of the things we've been doing is looking at how we invest in that pipeline. How do we really look at expanding training programs? A few years ago, we started working with UCLA Extension. We funded a medical assistant training program so that we can start training medical assistants to work in our system in clinics. And that's been highly successful, and many, many people want to go into that as their first forte into healthcare. I also think at this point, we also need more facilities and structures. One of the things, I think there was a period in time when everyone thought we would need less beds, all of the companies we were working with. We haven't seen that, right? And even coming out of the COVID pandemic, we are busier than ever. We have patients that are sicker than ever. We had a lot of deferred care during the pandemic. So we still need investments in, our most expensive resource, which is hospitals.
Yeah.
And that's a challenge to bring up in this economy.
Makes sense. Jonice, I always like to finish any of the sessions I moderate with sharing my so whats.
Yeah.
And I want to then give you a chance to either upgrade them or any parting
Okay.
comments. So I got 4 or 5 key so whats here. First of all, when you look broadly at healthcare and healthcare outcomes, we all need to remember that healthcare has improved overall. When you talked about survival rates and other things, it's easy to kind of forget all of that in the midst of things, especially over the last number of years. When you talked about the State of Union, a lot of challenges in cost. Cost was kind of 70, 80% of what you referenced, and that's something that's going to have to be worked. Third area is the role of technology, and huge opportunity in data, in AI, in telemedicine, in chatbots, robotics. These are all material things. These aren't on the margin.
Yeah.
These are fairly material items to outcomes. But important but here, compared to the United Airlines example, we have to always remember the change in context here, that we can't choose who's going to be our global services member on United Airlines. We've got to serve everybody if you're in healthcare. That creates a different context for just the kind of let's go reduce X cost and Y cost. And the final thing is keep an eye on competition. Amazon, may not be dealing with all the different areas, but there's somebody to watch and say, are there some things that we can emulate? Is there some areas to partner? And there may be a new model in the future that has them with you and a couple other leading players. Watch Amazon was kind of the message I took away.
Yeah, and you're exactly right. And we have discussed partnerships with them and with others. Every time there is a new player that comes into the industry, we like to have that dialogue and say, how can we be a partner? How can we be someone who works together? Because there are changes that are coming. And I do think these disruptors help push us into looking at things differently. And that's really important for academic medical centers who for many years really kind of operated, in certain ways. And so this is really something I think that'll push change.
That's great. Jonice, let me just say a huge thank you. I learned so much here. Your successes are not a surprise. When I read your bio, it is not a surprise. You've done well. And thank you for your service to Los Angeles, to the nation, et cetera. We're very fortunate to have you at UCLA.
Well, thank you. And thank the forecast, and really thank everyone who works at UCLA Health, who just does an amazing job that makes my job very easy. So thank you.
You're great. Thank you. Excellent. Well done. Thank you.
I think it's wonderful.
So that was so informative and insightful. And we're going to look at a lot of these other topics with our panel. We have a great panel. And so we'll start bringing the panel up. And while we're doing that, I'd like to introduce the moderator for our panel today is Jennifer McCaney. Jennifer is Executive Director of UCLA Biodesign, an early stage innovation program for healthcare technology, and Associate Director of the UCLA CTSI. Jennifer is an assistant professor in the Department of Medicine at the UCLA David Geffen School of Medicine, and also a lecturer here with us at the Anderson School of Management. And here she teaches courses on disruptive technology and entrepreneurship in healthcare. A co-founder of Hourglass Technologies, a Stanford biodesign company, Jennifer led early product development and also launched the MedTech Innovator Accelerator, which grew from an early cohort of 20 companies to a size of $700 million in financing. Jennifer's a Fulbright Scholar, completed her PhD in mechanical engineering at Stanford, MS in biomedical engineering from the University of New South Wales, and MS and BS in mechanical engineering from MIT, where she was a Draper Fellow and a BS in management science from the MIT Sloan School of Management. So please welcome Jennifer. And we'll invite the other panelists up, please.
And Harlan to come up and I'll introduce you all. Okay. Everyone's getting their mics on. So maybe while we're waiting for Brandon and Harlan, I'll just kind of kick things off and sort of, I think some of the overtones we've heard today, right? In healthcare, the need for personalized, high quality, high value care has never been greater than it is today. And where do our patients seek that care? They seek it at large academic medical centers. They seek it at primary, tertiary care centers throughout our country. And they potentially might start seeking that care at large tech companies offering services, much like we heard from Terry and President Spiso just a few moments ago. And so when we think about this pace of drug development, the pace of digital health, the pace of virtual care, right? Telemedicine is up to an 80% saturation rate since the onset of the COVID-19 pandemic. And what are the trends? What is really the forecast for healthcare based on the broader discussion that we heard earlier today? We sort of have a what I think is an expert panel assembled here today. We have a prominent health economist, venture capitalist within the healthcare system, and of course, innovation leader here within our Southern California healthcare ecosystem. So I'd like to start by introducing our panelists. Debbie, maybe I'll start with you. Faculty member here at the Fielding School of Public Health, of course. Debbie has an extensive amount of research actually in the development of much of the Medicare policy that drives some of the infrastructure we have here today that enable us to treat patients across every age range and group that we have here in the United States, as well as globally in countries like Australia and other markets as well. I think one of the things that's also so interesting about Debbie's biography, she's the former president of Claremont State University, as well as having held several leadership at other academic
Claremont
institutions.
Graduate University.
Yes, thank you.
I was going to be the chancellor here, but it fell through.
We can talk about that during Q&A.
Yes, we can if you want to know about that.
For those of you in the audience. She was also held leadership positions at Syracuse and Indiana University. So thank you, Debbie, for joining us. Maybe just going in order, Brandon Feeney is a prominent venture capitalist here in the healthcare industry at Providence Ventures. Brandon has previously held roles in healthcare tech, what we sort of call healthcare tech-enabled services, right? So healthcare as a service, and we'll talk a little bit today about, I think, healthcare even as a product, right? The productization of healthcare, and what does that mean? Brandon has held roles at Transformation Capital, Strathspey Crown, which is a Newport Beach-based firm. He sits on the board of Macro Health, Omada, as well as other leaders in the healthcare industry. Brandon, thank you for joining us and flying in from Salt Lake. And a final esteemed panelist is, of course, Dr. Harlan Levine, who's the president of Health Innovation and Policy at the City of Hope. One of the things that's so interesting about Harlan, he's very active in the Southern California community In addition to sitting on several boards, he's on the board of Bioscience LA, which is one of our partners here in the Los Angeles ecosystem to really drive innovation across the life science industry. And of course, our partner in the Techquity Accelerator here at UCLA Health. Harlan has previously held roles at United Group, Towers Watson, as well as Anthem, now known as Elevance. So thank you all for joining me today. I'm gonna take my seat here on the esteemed panel, but I think we have a great starting point for the discussion today and thinking about one, just California and our Southern California ecosystem in healthcare, as well as the national and global implications for the healthcare economic forecast. We talked a little bit, sort of, Terry, you gave us the State of the Union on healthcare, right? Many of the things we know, rising costs with respect to labor, supplies, increasing demand, and how do we balance this all in the face of rising inflationary pressures, as well as an impending recession, as we heard from Leo and Jerry earlier today. And what does this all mean for healthcare, which has primarily been a recession-proof industry, if you will? Will healthcare continue to remain recession-proof? Will technology help us to do that? And I think we have the right group of experts to help us discuss some of those questions today. But let's maybe just begin with hospitals, because I think it's a nice jumping off point after the discussion between Terry and President Spiso. And let's talk about hospitals. And I think just to preface the discussion, we talked a little bit about to say, but what I will say is that hospitals have previously operated on a care delivery model, right? Delivering a discrete sort of bundle of care services, mammography, orthopedics, dermatology, primary care. And what we've seen now is healthcare is becoming productized, right? And a lot of these products, so healthcare as a product is a fairly new kind of, I'd say, theme or business model for healthcare. And we see technology companies, we see other companies productizing healthcare, kind of eating off those big margin services, right? Ambulatory surgery centers, we have private equity buying up ambulatory surgery centers. We have Amazon and Google and the big tech, right, getting into healthcare. Is big tech eating healthcare? If we're gonna go on the Anderson Horowitz analogy. And so what I'd like to kind of think about, how is healthcare doing in the sort of productized world? And what are the implications for that, of course, in the impact of the COVID-19 pandemic? Are we gonna continue towards this productized model? And what does that mean for healthcare? Maybe we'll, Debbie, maybe we'll start with you and work our way down and then see where the conversation leads us.
Is that what you said?
Yeah.
The productized model has helped with healthcare costs, but I still see a problem potentially with it. If everything is separate, we're in the same lack of coordination that we've seen all along. My concern is that if you have something outpatient and your doctors don't talk to each other and it's not all coordinated, you have no ability to really know what the outcome is going to be and what the cost is going to be. One of the things that our esteemed head of the health system here was talking about was AI, which can help, but I have some concerns about it too. AI can really help with healthcare outcomes, but in my view, it shouldn't be limited solely to the electronic health record at UCLA. We have all sorts of issues regarding EHRs not talking to each other, but potentially what AI can do is if you have a really rare disease, you should be able to look at data all over the world to see what are the treatment options and be able to analyze what produced the best outcomes. But we don't have the interoperability to do that yet. And so if I put this all together, we have an issue with equity laying into all of that. We have tremendous disparities, which may impact health outcomes in ways that we're not collecting data. That's where social determinants come in. And the delivery system isn't set up that way. And more importantly, as I'm sure you've all read about burnout. I presume physicians and nurses have been pressed so hard during the pandemic that many of them want to retire. And many of them also who have practices, whether they're consolidating or not, and we'll talk about that, I'm sure. Many of them who have practices don't want to deal with the quote administrivia. That is, how do I bill, or how do I send in a claim to 20 insurers? I don't really know. I don't really know or have the time to put all the data I want to put into an electronic health record, and I have to hire somebody to do that. So with AI and all of the pieces, we have a real dilemma about how we're going to bring our providers into this and provide them the support, not only to coordinate and analyze the data, but to keep them from burning out. I think we can solve it by more coordination than we've done, but that is a difficult task. And then with all the consolidation, which a lot of economists say, oh, it's leading only to higher costs. I will tell you, I don't think we've had enough time to do the research to figure out if outcomes really improve. Because when you consolidate, you're talking about if UCLA, or I've been on the border at Cedars-Sinai, coordinates or buys another hospital, your physicians have to get to know each other, your cultures have to learn to merge, and it takes a very long time. So we have a world in healthcare, in my view, in the United States that adds fantastic ideas, but it isn't, they're either siloed, it isn't all coordinated, and our providers often aren't at the center and don't learn how to deal with it. So we've got a lot to do, in my view, but this is the country of innovation. And I can tell you that with things like value-based payments, other countries are watching what we are doing. So even though their healthcare costs are lower, and I can tell you their outcomes are generally better, we're the innovators and they're going to use it to their benefit. So I think we just need to get our act together of coordination.
Healthcare is incredibly complex. And because of that complexity, I think there needs to be specialization beyond medical specialties, of course. I mean, when you think of certain organizations or teams taking care of this population or this particular need is needed, not just because of expertise and IP, also because of cost structures.
Right.
So an emergency department with that kind of cost structure should not be taking care of patients with a low acuity need.
Right.
Right. So that kind of idea of segregating how groups of people that are taken care of according to acuity or according to condition, that type of separation, I think, is necessary. Where the challenge comes is exactly what you said. This leads to a fragmentation of care. And so if care is fragmented, how do you solve for that? Well, that's where interoperability comes in. As you mentioned, other technology tools, but also it's not just technology. Technology is never the silver bullet. It's also aligning incentives with the financial model. This is where bundling comes in and capitated arrangements and all the kind of alternative payment models that we talk about. And then on top of the financial model and that incentive alignment, on top of the technology, you have this third big kind of nebulous category that people gloss over, but it's about change management and organizational design and mindset. You know, at the end of the day, even though 60, 70% of the hospitals in the country are not for profit, they still are a business. They still need to generate revenue and need to make a profit to reinvest in growth, to ultimately take care of patients. And that requires a certain business and innovation mindset. And there's a reality that we're in a competitive market. And I know we'll talk about this later in the panel discussion, but there are new market entrants that are very much for profit.
Yes.
And you need to be able to compete with them to not just stay open, but to provide a public good to the community. Hospitals can't be closing down, and that's what's happening. So I'll stop there, but that's.
So I want to start by, I want some credit because when you said healthcare is complex, I wanted to interrupt and say, who knew? But I didn't want that to be my first statement. So I decided to just wait till now, but it is complex. And I think that when we have panels like this, we're looking for sort of soundbite answers and we expect everything to be homogeneous. And the issue is it's not going to be a homogeneous solution. Each market is going to have different needs and You know, if you look at it from, I was listening to Jonice speak, and, you know, if you're part of a UCLA system, almost anything works for you because you have the whole ecosystem here. But if you're not in the UCLA system in the broader LA or Southern California market, it just doesn't work that well for you. So the system's broken and there's great health inequity. So I think what I would start by ask us to think about is we're kind of at an inflection point here. We just went through this perfect storm with COVID where our systems were overwhelmed. We're having a labor shortage. We're having inflation. We have a pandemic that's scaring people. And, you know, we would applaud for doctors and providers and nurses at 7 p.m. And here we are just like a year later, we're kind of back to where we were before. And I think we've forgotten that the hospital infrastructure we have is an important part of societal infrastructure. Like when we're sick, we need a place to go. And we've been living for the last 20 years with this notion. And by the way, we just mentioned my back. I don't consider myself a hospital person. I consider myself sort of a healthcare ecosystem person that ended up at a hospital because my non-compete didn't allow me to do anything that I knew how to do on the health plan side. So I had to find a new trick. But, you know, we treat the hospitals as a commodity. And, you know, we've rewarded hospitals for efficiency. We pay them at the lowest possible price to cover chart cost and have a little bit of margin. And we talked about the fact they need to have a margin. Well, hospitals have a lot of infrastructure and a lot of IT. They need significant EBITDA just to break even, to reinvest or to cover amortization. So when I hear my colleagues and, you know, from where I spent most of my career on the health plan side, talking about learning to live on 2% EBITDA and things like that, just doesn't work for hospitals. So here we are, we're still in the middle of a pandemic. We've been talking about how important the hospital structure is, and we're right back to where we were before. And I think we need to follow the money. Here in Southern California, there's lots of models, but we tend to take the insurance money, give it to a large medical group, and then that medical group is negotiating for the lowest possible rates. And what's not part of that discussion is who has the best outcomes, who has the best patient experience, who can get the patient in the fastest. And so the thought I would leave you with is we're going to probably talk about here or elsewhere value-based healthcare. Let's start by defining what's value to whom and how do we prioritize among all sorts of priorities that we have in healthcare today.
I absolutely agree. And
Well, that's not
our
fun.
measures of value now, I think, are not very good.
Yeah, maybe let's go with that. Let's talk about value-based care, right? We have value-based care has been a discussion point in our healthcare ecosystem for what, 20 years now, right? And we're sort of thinking about some of the initial theories that, bless you, Debbie.
I'm sorry.
Michael Porter, you know, a prominent health economist, and this idea of the integrated practice unit and the idea of sort of tier 1, tier 2, and tier 3 quality metrics. And I would argue a lot of value-based metrics are well beyond a 30 or 90-day window, which is what Medicare is currently reimbursing value on. Value is a lifetime of patient care. And so how do you think value-based care is doing? Are we implementing, are these even the right metrics, maybe as Debbie has suggested, to implement value-based care? Maybe we'll go Harlan and work our way back.
So, I mean, I think it depends on the condition. And I like what Brandon was talking about, was sort of segregating by severity or acuity of illness. I think, so for value, so I work at City of Hope, so let's just focus on cancer if you allow me to do that. Value-based care, you know, there have been programs out by the payers and government that give rewards for doctors, but they tend to reward process measures or certain, you know, staffing ratios. But nowhere in the discussion was there anything about survival outcome. And if you're a cancer patient, when you talk about what's valuable to you, it starts with survival, functionality, quality of experience, access to research. There is no value-based program that focuses on those. In fact, most of them don't even touch on them if you touch on them. So, you know, I think as you get into the more serious illnesses, the value-based programs start to break down because you're really talking about affordability and cost and unit cost. we're here at UCLA, so let me give some positive accolades to UCLA. If you needed to get your valve replaced here in California, there's probably about 15, 20 hospitals that could do a really good job replacing a valve. But if you need to have 2 valves replaced, there's probably 3 hospitals in the state that I would send a loved one to. There is no ecosystem, no value-based system that actually breaks it down to that level. If you're the patient, you care about stuff like that. And the problem is we get swept up and we treat it all like preventive health. Look, I'm a primary care doc, so I get preventive health, primary care, secondary care. You have a lot of laxity with that. But when you get to more tertiary and quaternary care, and we talk about value-based care, we need to define what value is to the patient and then build a system around that. And we don't do that today. We kind of allow the big healthcare systems or the payers to decide what value is. And I think we need to grab that back in healthcare today.
So I'm going to start with, I don't know the answer here. I don't know what the solution is. I don't think anyone does. But I do think that when we do talk about value and how you define it and how you measure it, it does involve a continuous patient relationship so that you have a longitudinal view to the patient journey. You need care coordination so that you solve for that fragmentation of care. Perhaps you have that segregation by acuity, and perhaps you involve, third-party tech vendors to stitch everything together. But on top of all those potential sub-solutions to the overall solution of actually solving for value, the fee-for-service model doesn't work in many cases. In some cases it does, I gotta say, in some cases it does. But if there's one thing that COVID taught us is that depending on a fee-for-service financial model, especially when it comes to cross-subsidizing profitable procedures, or using profitable elective procedures to cross-subsidize everything else, it exposed the weakness in that model. And so as we move towards value-based care, looking just at cost is not the answer, but looking at a continuous kind of customer lifetime value, if you will, and comparing that with taking the cost of taking care of patients, maybe using cost is a good step towards value. And that's why, when I look at the type of care that patients can get by investing heavily upfront into primary care, investing in the necessary infrastructure to actually have the global and coordinated care team around them upfront, that is shown to over time reduce costs associated with care of the patient, which in that case, it's a proxy for quality of life. And of course, there are exceptions to that. But I guess it's a long way of saying is, though we don't have the answer to it all, there are, I think, obvious steps we can take that move away from this traditional fee-for-service in every case structure.
I agree with everything that has been said and agree that we need to have longitudinal measures of outcomes. But I think at the same time, given where we are, as things advance, we still need for things like ACOs and for bundled payment models, we still need better outcome measures. Let me give you an example of something. And this relates to what Janice has said, and I would love to meet her because I don't know her. Love to meet you. And I was the PI of a large grant back 25 years ago to study outcomes associated with knee replacements and hip replacements. What many of you may not know is this is the procedure that Medicare pays for the most, okay? And we learned, first of all, and so just let me give you an example. If many of our value-based models look at a value measure or a supposed quality measure, which probably isn't, which is where you in the 90-day period, which isn't often enough, which came up, often look at whether there was a readmission. Why? It's easy to measure that, but that's not really what you want to know. If it's a cardiac procedure, let me give you a knee replacement procedure, that's not what you want to know. With the knee replacement, you want to know, did somebody get their function back? If they were a tennis player, can they play again? What's the quality of their life now? If they have a grandchild, can they get on the floor and get up? There's surveys, which I'm biased, I designed, that are still used to measure that. We could measure them and put all of that in an electronic health record, but we don't do that. Another thing that
Because
was
it's not rewarded.
right, because it's not rewarded, but that's what you want to reward. So we, in my view, use the wrong outcome measures when there are better ones available. And another thing that was alluded to before, or maybe by Janice, was that volume matters. Over and over and over again, we know that if you've had a procedure or you have a problem, somebody who's dealt with that, a provider who's dealt with that 300 times gets a better outcome than somebody who's dealt with it 10 times. But we don't provide important information like that to patients. And whether we're talking about an ACO, we're talking about a Medicare Advantage plan, we're talking about any other model, we don't give that information and we don't steer them that way. And if we did that, we get better outcomes. So there are a lot of things we could do as we strive to follow people for 20 or 30 years. And doing one is supposed to be a step towards the next. It's not, oh, I've done that and it's over.
Let me comment on two things that were said, if I can retain the thought. Maybe I should say one and hopefully a second one. So on the comment about fee for service, I'm going to push back a little bit because I think in general, our payment methodology in healthcare hasn't served us well. But I think the industry, and you didn't say this, but the industry is gravitating towards, well, fee for service isn't good. Let's go to capitation, which is this full prepayment. And even better, let's put doctor groups in charge because that's safer than having Aetna or United in charge. A lot less regulated, by the way, but it feels good to have a doctor in charge. But the issue is if you are a medical group, or you're a patient in a medical group and you're not signed up for the UCLA medical group, and you need the things that Jonice were talking about. I know she mentioned CAR-T, I don't know if she mentioned BMT. That medical group is not going to look at the results of CAR-T there versus somewhere else. They're going to look at the unit price. I can price CAR-T cheaper if I go to another university. And they're going to make a choice based on that. They don't look at the outcome data. And that's a fundamental flaw. Like I will just, say City of Hope unequivocally has had the best BMT outcomes for 17, 18 years. Only one health plan says to us, you know what, we're going to go to extraordinary efforts to have you in our network. Everyone else treats us like the rest of the country because they don't really care about the outcome. So that's, I think we have to be careful on capitation and make sure we have safeguards that until there's transparency about the data and the quality and people are choosing, you can get trapped in a system and not. And the second point I want to make is related to that, which is the system seems to be working okay for some, but it's just not working for all. So as we move more and more towards these prepayment models, we're burying people into these groups. And by the way, I've worked in the health plan business. I use capitation. I use all these tools for most of my career, paid for my house nearby here. So, I don't want to be a hypocrite, but we have a health equity issue here, which is the system is broken today. If you are an African-American male, you die at twice the rate of your white counterparts from prostate cancer. If you're an African-American woman, you die at 40% higher rate. The numbers go on. The further you are from an academic center, the difference your zip code is, the higher your death rate is from cancer treatment. We have to address that issue. And there is very strong evidence that this capitated model, prepayment model, is great for preventive care and primary care. There's very little evidence to show that it's done anything to improve secondary care. And there's a lot of data to show it's worse for minorities and underserved populations. So we have to be very careful we don't jump. I don't know the solution. I mean, I'm not pretending to do it, but these are really complicated issues and we have to really dig deep. And every time you take one action, you have to realize you're part of both an ecosystem and an equilibrium, and you can knock that equilibrium off kilter. And oftentimes it's the people from underserved and minority populations that bear the brunt of these unintended consequences.
And I would say you're right on. And on the equity issues, one solution has been what's called risk adjusting, which means adjusting what somebody gets paid for by things like race and ethnicity and severity for those individuals. But you know what? That doesn't deal with the access problems that might actually improve their outcomes. So this is very complex, and I agree with everything that was said. We need to put it together. Fee-for-service is going away for those of you not from health, just because people are concerned that it incentivizes doing more care that's unnecessary. So we've got to figure out a way to put it all together, and you're absolutely right on investments and so on.
Yeah, I think one perhaps analog to these underserved ethnic groups is underserved geographic groups. So it's very analogous to, say, a rural population where, where hospitals are shutting down, where telehealth is trying to make inroads to provide that access. But instead of paying more in a risk adjustment way, there's an access solution potentially. Look at people, this might seem controversial, but when you look at who's poised to help in rural communities, at least on the lower acuity side, Walmart is 90% of the population in the US is within 10 miles of a Walmart. So they have this installed base of stores, many of which, not all, not even close, have clinics in place. That's not paying more for healthcare. That's literally just providing access. And then on top of access, when I think of things that I've invested in, simple technology communication tools, texting tools, automated phone calls to in-person phone calls to you name it, any type of communication modality. There are cultural sensitivities that need to be in place to engage these types of population. So, when you are trying to provide better outcomes, oftentimes it goes hand in hand with increased, care plan adherence. And increased care plan adherence comes from actually engaging in a relationship-based way with a person, and people from different cultures require different types of personalization, which sounds so like, of course they need that, but still, patients are still treated in many ways, at least on the primary care side, like a one-size-fits-all.
And you're right on. And for the audience, I want to tell you about some research that's very related to that, that you may not know about. But first, on the community level, this is why we have a whole burgeoning field of community health workers and people who can get out into the community to work with patients and spread the word. And it's one thing I'm sure UCLA is doing, and that is really getting into communities, getting close and working with them to improve the care that they get. Now, on the research I wanted to mention, there's been research on what we call racial and ethnic concordance. And it shows that if you go to a provider who's of the same race or ethnicity as you, you develop a better relationship and your outcomes are better. But we have a shortage of so many types of providers that are necessary, highlighting the two most: primary care and mental health providers. And we have a shortage of people of the same race or ethnicity. People are trying to deal with that, but it's not happening fast enough. And that doesn't mean that people will be appropriately paired together, even if they're there, even if it makes a difference. So there are a lot of things that go into all of this that people are really trying to fix, and for good reason. But then, you know, if we have a health plan, since you used to be in one, and I've been on the board of a couple of them, then that health plan is going to have to tell you about things like volume, try to put you together with a primary care physician, since you've been, you know, and primary care is so important, or a nurse practitioner of your same race or ethnicity. So there are a lot of things that we can do that we're not doing, but we're working on.
So you mentioned something, I'm going to not verbatim, but more or less feet on the street in the community, in a way that, you know, it's not necessarily increasing technological costs or changing the reimbursement model. It's literally just placing people in certain communities who understand the needs and the cultures of these people. That begs the challenge of just the shortage of providers.
Absolutely.
You know, where are we going to get all those caregivers? And I'm not just talking physicians, I'm talking all the way down to the unlicensed caregiver, unlicensed social worker. And one thing that I've always believed in, and there are limitations here, especially when you get into much more complex care, is leveraging latent talent in community resources.
Yeah.
So there are community resources, whether it's EMS services or the local independent pharmacies, that are equipped to, at the very least, handle even simple house calls. Now in California, and we looked a lot at this at my firm, California has tons of regulations about that, around what an EMT can do on behalf of a patient without a physician present. But for most of the country, EMS services can provide an urgent care call and telehealth the doctor in, but still provide care, 85% of the time. And then when you think about a pharmacist, they're often, relegated to, I titrate the medication and I provide it to you. No, they can actually get reimbursed for medical services in now, 25, 30 states. And so I guess the point that I'm making is there are community resources that are available that if we were to tap into them in a safe, professional way, that could be one small step towards
Coordinate them, I agree.
Coordinate them, of course, with the existing care team resources.
You both touched on some really important points. So one is this highly regulated industry, so change comes fast, and we're going to have to look at the regulation. And I'm not like a pro deregulation person, but I feel like, even the board certification processes are very slow in getting folks certified. They're the piece. We just need to look at workforce entirely different. All these models, even One Medical that was mentioned earlier today, it's still a physician-centered model. They use technology, they use APPs. We may need to flip it the way you're suggesting, looking at it from a community base. If you look at the senior population, it's not a medical condition, but loneliness is a huge issue. You don't need any sort of licensure to go in there and address loneliness. You need the equivalent of a neighborhood watch program where people, and then the diversification of workforce, of course, is both important because of shortages, but also because of the matching, and it's the trust. I mean, the lesson from the pandemic is that trust in the healthcare system is not anything close to what we thought it was. And part of it is this cultural divide. Part of it is how we communicate. So there's all sorts of opportunities to fix the system from the ground level up, which is what you guys are saying. And I think that needs to happen at the same time while we're training for the more sophisticated, while we're learning, to use the data more appropriately and to treat disease. We need to figure out how to solve early healthcare issues as well from a societal point of view.
And so I think in the interest of time, it will just a quick wrap up, because I know we started a little late. Amazingly, we touched on the entire panel discussion somehow without me even having to moderate. So thank you for our panelists. But I think, in terms of, I think Steve Gordon asked the question at the beginning of the day of Jerry, and he said, so what's the outlook? Are we still 50-50? And maybe in just closing, a minute each from our panelists, can healthcare, in spite of or in light of many of the challenges you all talked about today, can we remain resilient? Can we deliver care in, the light of, potential economic downturn in the next year to 2 years? And maybe we'll just do a quick rundown. And we'll start maybe with you, Brandon, and work our way back.
Sure. So I look at what happened during the 2008 recession as the most recent analog, and lot of similarities, obviously, around the macroeconomic conditions. But what's different in healthcare versus 14 years ago? There's a lot more cost sharing on the consumer side. Premiums have gone up by 7% each year as a result. And maybe there's some confounding variables that it's not a causal relationship, but I think consumers are more sophisticated now as well. And so I think healthcare spending, and this is kind of an optimistic view, will become a little more sophisticated if a recession comes. Because again, more of the cost is falling on the patient. There's more technology and data and more competition, and therefore patient choice now than there used to be. And so it's kind of a long way of saying, I can't predict the future on what will happen to healthcare, but I do think innovation will continue. Even though, when I look at my world, venture funding is at a 5-year low right now. That's not surprising. I mean, it happened 14 years ago. It happened during .com. The best performing companies emerge from these times, these troughs. And I don't see why that would be different this time. So I'm optimistic about the future, but what can't happen is burning money, which has happened both in healthcare and in my industry in venture capital. So hopefully that will happen less.
Harlan?
So I'm optimistic as well. I think for many of the reasons Brandon is, I think we're just going to have to get smarter about investments. I think you'll see perhaps fewer startups and fewer poorly funded enterprises as people consolidate their investments in things that really matter. I think the other difference between now and 2008 is that the government's really gotten involved in healthcare through the Affordable Care Act and the expansion of Medicare Advantage. And it will, once you go down that path, you can't go back. So there's gonna be a lot of regulation, there'll be a lot of price controls, and I think that's unavoidable. So we have to figure out, all right, so as a provider, you can see some downside to that, but then how do you see the upside to it? So the upside is everyone basically has coverage. So I think it's really incumbent in not just hospital providers, but the ecosystem to think about, like, what do we do now with this whole population that has coverage for care? Are there solutions that we can build and invest and create value in a way that, used to be hospital centered and now it's going to be preventive center. So I think that's
community center.
The community center. So I think it's a huge opportunity. The other thing that, we didn't touch on because of time, but the ability to process data is significantly different than 2008. Going back before 2008, but in 1950, medical knowledge, yeah, a little bit, when I was a kid, come on, I wasn't a kid.
You're still a kid.
Medical knowledge doubled every 50 years. Every 50 years it doubled. Today, it doubles every 73 days. So, it's just a fast time. So we have to learn how to manage data, and we're already doing it. I just give one example why I'm so optimistic is we use the term precision medicine as if it's like precise, and it's anything but what it's done is taken genetic signals and using AI and huge data sets, been able to affiliate these genetic signals to specific cancer, specific risk, which have led to targets, which have led to new treatments, which have led to diagnosis of lung cancer that you would have died from 10 years ago within 6 months. People are living 80 months and more. So that is already out there, and we're getting further upstream in being able to recognize people who have cancer and we don't know it. But even, for non-cancer perspective, we can understand now about signals and mutations in the blood that tell you about your health risk that you haven't manifested yet. And we're just at the tip of doing that. But if you can do that, think about how more efficient the ecosystem can be in keeping people healthy and motivating better behavior. So for all those reasons, and including, of course, telehealth and the connectivity, I'm optimistic, and we have to have a healthcare ecosystem here as part of who we are as Americans. So we're not going to let it falter. We're going to always, keep it strong, I think.
I couldn't agree more. I don't have much to add, except to say that for as long as we've been struggling with our delivery system, I'm very optimistic because we have found some solutions that seem to work, and we seem to change those that don't. And let me just give you an example. I sit on the board of a community hospital out near where I live in Claremont. And the pandemic hit everybody horribly, every hospital. But this hospital, we used it as an opportunity to learn to clean up some of the things that weren't going well and how to coordinate other things so that we save money, so that the bottom line is much better now. So I think we can always learn from bad things and make them into good things. And I'm optimistic. And unfortunately, I have a Zoom, so I'm going to have to jump off.
Everything's going to be great. Everything's fine.
Fantastic. Well, there you have it from our panel of experts. Just to wrap up, I do have confidence in some of these strong horses, if you will, versus kind of what we were seeing now, the thinning of the unicorns. And certainly with respect to infrastructure, digital delivery of healthcare, as well as looking at the future and the health of the healthcare early stage sector overall. I'm sure, Brandon, you would agree, and we talked about earlier, banks are failing, hospitals are failing, right? But the general sort of thematic takeaway is that I think we are resilient. We can deliver and continue to deliver care to patients, and hopefully continue to do a better job of delivering care to patients across rural and underserved communities, as well as here within our own community in Los Angeles. So thank you. And Jerry, I'll turn it back over to you.
Thank you, Jennifer. Well, thank you, Jennifer, and your distinguished panel. I think we've learned an enormous amount today. And so as we wrap up, I want to thank the sponsors again. We really couldn't put these kinds of programs on without them. And then I'll make a final comment. So first, Dick Simon and Steve Gordon, and Edison International, Southern California Edison, our special forecast supporters, RSM, our principal sponsor, law firm of Allen Matkins, California Bank and Trust, Cathay Bank, Clark Construction, Leap Development, and University Credit Union are our platinum sponsors. Avenue Insights and Analytics, California Steel Industries, Venture Forward by GoDaddy, Hub International, Pacific Western Bank, Robert Half, and United Airlines at the gold level. At the silver level, Bank of California, Scott Work, North America, US Bank Private Wealth Management, Union Bank, the private bank, Valley Bank. At the bronze level, HDR and Marsh McClellan Agency. Our Bruin sponsors, Gerber Kawasaki Wealth and Investment Management, Keenan and Associates, Navitas Health Solutions, and our academic sponsor, UCLA Extension. And my last comment is, while we are here, the market has now priced in no increase in interest rates by the Fed in the next meeting, or at least a 60%. And oil prices have come down by about 10% or more. So the economy is very much in flux. Thank you again to our panel and our keynote, and to all of you. And final comment, Shakespeare wrote the lines, "Beware the Ides of March." I don't think he meant this inundation of rainfall, but beware the Ides of March, drive safely home.